And the deflationary picture out of China. We'll check in, of course, in terms of the European futures, looking healthier as Italy and the government there looks to, is it a U-turn? Certainly a clarification when it comes to that surprise windfall tax. European futures pointing to gains of a little over 1%. DAX futures pointing up by 131 points. UK, you're looking at gains of 45 points, up 0.6%. Over in France, 7,363 is the picture. The markets are opening then. Let's let the pricing action just percolate through these markets. The FTSE 100 currently up about 0.1%. The earnings picture, of course, continuing to round out the story for us. Bit of a mixed picture. Yes, turbines, renewable energy, that remains a concern. Supply chain constraints, the margin pressure coming through for Vestas. But you did have some beats coming through for the likes of ICAP, the brokerage, of course, as Joe Easton was pointing out for us. The Spanish IBEX now up 0.9%, gaining 1%, I should say, in terms of the upside coming through. There was pressure on the banking sector in Spain as well. The ripple effects of that decision, the policy announcement out of Italy, impacting Spanish banks yesterday. But you are recouping some of those losses, at least in the first few seconds of the trading session today. Over in France, gains of 1.2%. Here in the UK, the FTSE 100 adding 45 points, up 0.6%, holding above that 7,500 level. Let's flip it over and look at sectors then. Banks certainly in focus, Baker's Resources, energy as well. We're speaking to the CEO of E.ON, who was talking about the changes in the energy complex. Businesses, households still need to be cautious as we lead into the winter, was the line there from the CEO of E.ON. Basic Resources currently up 1.5%, 1.4%. Energy gaining 113 points as a sector, up 1%. Travel and leisure is in the red, down 0.4%, and we're looking for banks. There's the gain there then, 1.4%. Again, as Italian government ministers modify their messaging on that windfall tax for Italian banks. We'll get more of the details from Sam Unstead and team just in the next few minutes. Auto's also gaining 0.6%. Broadly, you're positive across the session midweek on Wednesday, with the focus on the reversal, it seems, in banks. Sam Unstead, let's get the details then from our Markets Today blog. Sam, not a big surprise, I guess, in terms of recouping some of the losses. We had expected that, given the changes in the language from Italy. Do we have any more details in terms of the material impact of this windfall tax on Italian banks and how much they've just walked this back?
I think it's been, I don't know if I would even say it's been walked back enormously. I think yesterday's comments were quite off the cuff, and I think that really hit the market, I think, probably a little bit harder than they initially had anticipated. I think those comments have now been softened a little bit. I think you'll see Italian banks move up today. It'll also help just the sentiment with banks generally. You saw actually Spanish banks took a little bit of a hit yesterday too. Those are likely to rise again today. I think what you see here, though, is just this consistent concern for banks in particular that we talked about a few moments ago, actually, with UK banks, about political risk, you know, and for Italian banks in particular, where they have been particularly leveraged to rates, so they have made huge profits from rates going up. I think they are still at risk of seeing more issues with the government there.
Okay, UniCredit is gaining a little over 3%, 3.3% on the back of that news then, as you say. We're going to be speaking to Octavio Morenzi, a banks analyst, later in the show, who says, to your point, this underscores the concern that, well, if banks are in focus as a potential windfall, what about energy companies? What about the defence complex? And the list goes on, the risks then and the concern in terms of investor appetite, and we'll unpick that with Octavio. Meanwhile, China data is in focus again for us today as we look at the inflationary impacts here in US and Europe, and the question as to how far and how fast that inflation picture is going to come down. China is in deflation.
Yeah, and I think they're broadly expected, you know, and really this is another, you know, we had the trade data yesterday that was very poor. Another pretty weak report out of China that mostly appears to have already been priced in. I think the question, and actually you alluded to this a little bit earlier, is what's the government going to do? You know, does this deflationary report, does this push them to do something? You know, you're seeing the issues in the property sector there. It's getting sharper and sharper. So now it sort of moves away from the data and back onto authorities.
Back onto that policy response. Robin Shing of Morgan Stanley saying that is exactly where the focus is, that need now for the government to respond. Deflation is the story in China, if not elsewhere. Sam Unstead, thank you very much indeed. Sam Unstead, of course, from our Markets Today blog. Thank you. You can get more, of course, from the team, Sam and the team, on the front page of the Bloomberg UK website. Really do check it out, or by typing TLiveGo on the terminal. Let's get a check on some of the individual stocks on the move. It's an interesting day, despite where we are in terms of the summer season, Joe. What is in focus for you? What's moving? What is jumping at the open?
So TPI cap is the one I can see really jumping at the moment, Tom, up 11%. They are reporting that their individual brokers have made more money than expected in the last quarter and also the half year as well. That's one of the best performing stocks on the London market, up 11% at the moment. ABN AMRO, a bit mixed. There wasn't as much of an upgrade to the net interest guidance as some had hoped. That the buybacks are also in focus, and that looks pretty strong in terms of the Dutch lender. One of the last firms to report from that sector during this earnings season, but that one just turning negative, as we can see. You mentioned UniCredit. The Italian bank fell around 7% yesterday following that tax news, coming back up a bit, given the latest update that some of those taxes won't affect more than a small percentage of the assets, according to the Italian government overnight. Flutter, meanwhile, the owner of Paddy Power, that one looks strong in the UK, but there's some weakness over in Australia. The Aussie's not gambling enough, according to Flutter, listed over in Dublin. That one down 3% this morning. Then we're going to flip over and review a couple of other earnings stories. So we had Vestas, of course. Now, Vestas, very weak, but pretty much priced in, given we've had warnings from them and Siemens Energy. Siemens Energy also downgraded over at JP Morgan, but Vestas really coming back up, gaining after falling so much over the past couple of years. Delivery Hero, everyone's still splashing out on takeaways on Saturdays, and that one is up 6% over in Amsterdam. That was expected to be a bit weak, given the pandemic is easing, but we're not seeing signs of that. Delivery Hero, a big jumper there. L'Oreal, meanwhile, this is a read across from L'Occitane Provence. I'm sure I'm not pronouncing that correctly, but that company is being potentially taken private by its owner. That's the big pharma and also luxury goods company that's listed in Hong Kong, so skincare, that kind of thing. That's a bit of a read across there, up 1%. Novo Nordics, that one woke us all up yesterday, didn't it? I was having my mid-afternoon nap and that news broke, up 17% yesterday and still gaining. I thought that one would come down a bit, given it rose so much yesterday. On track to become Europe's biggest company by market cap and still going up around 0.8%. A pretty decent move for the size of that company after that shock obesity data news that we got, as I say, in the afternoon yesterday. Finally, we're going to have a look at some of the autos that we mentioned in stocks to watch. Continental, it was weak, the sales were poor, the margins were poor, but again, all of that really priced in, and that stock gaining almost 2%, pretty good return, given the negativity that was in that statement today. And then we brought up those stocks that Citi had in their note. Now, BMW gets a sell rating over at Citi. We can see that one just turning into the red like magic. That was great timing. So that one is downgraded to sell over at Citi, but Volkswagen and Renault, they get buy ratings and they are gaining up more than 1%. Renault nearly 2% over in Paris. A bit of a turning back green again. A nice picture on the auto sector today.
Joe, very nice indeed. Thank you very much indeed. We'll be speaking to the CFO of Continental, of course, an applications provider. They provide, of course, solutions and hardware to the auto, of course, industry. So we'll be talking to the CFO later this hour on the back of those results. Joe Easton, of course, from our equities team, thank you very much on what is moving in the session this Wednesday. Here's what else we are watching out for today. At midday, we're going to get US mortgage applications. To what extent is that starting to dry up? The application process for mortgages in light of higher rates in the US. That's going to be an interesting gauge. And at 1 p.m., We're going to get Mexico CPI, so inflation prints out of an important emerging market, of course. Bloomberg Intelligence does expect the number to decelerate for the 6th consecutive month. So inflation coming down substantially, at least in Mexico. In the evening, we're going to be watching the $38 billion US 10-year auction. The 3-year was well received. The 10-year, that may be slightly trickier for the US Treasury. Important, of course, for these markets. We'll watch that. Finally, later in the day, Disney reporting earnings, of course, a gauge in terms of the movies part of the business and, of course, their resorts as well in terms of how much is filtering through and the streaming service for Disney. That's going to be an interesting earnings picture to watch. Coming up, from the Italian bank's shock to a weight loss, drug-driven share frenzy, European equities, well, they're drumming up compelling narratives this week. Anything but dull, that is for sure. We're going to dig deeper into them next. Stay with us. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision. I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Earnings season is here.
Another crazy busy week.
There's still a lot of uncertainty.
The market knows that there's bad things coming.
Bloomberg breaks the numbers first.
A slew of earnings. Some breaking earnings.
What did we learn from earnings? I mean, a lot of them beat. Some of them got slammed.
With exclusive expert analysis.
This is a growth story.
Advertisers are pulling back. It certainly will be a headwind.
Good revenue growth across the globe.
A record year.
We haven't seen a result like that since a decade.
We're not standing still.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back. This is Markets Today, almost 13 minutes into the European trading day this Wednesday, and the sentiment is slightly more positive. You have a couple of factors coming through. The Italian government just clarifying the details around that surprise windfall tax. So Italian banks recouping some, not all, but some of the losses of yesterday. The deflationary picture out of China, not a major surprise, and not doing much in terms of the equity action in China. We look ahead, of course, to the CPI, the inflation print out of the US on Thursday. But again, the slightly more positive mood across these markets. The Bloomberg Dollar Index that had been bid yesterday in that kind of safe haven tilt is softening in the session today, down around 0.2 of 8%. Let's get a recap then in terms of how these European equities are shaping up. There's the earnings picture, the earnings story that's filtering through as well, of course. Let's bring in Marcus Morris-Ayton, European Equity Portfolio Manager at Allianz Global Investors. Marcus, let's start top line then. European equities year-to-date, gains of about 8%. What is your view in terms of how much further European stocks have to run this year?
Yeah, morning, Tom. It's a good question, and here we are towards the end of earnings season, which is always a pivotal moment to assess the corporate health of the companies we're looking at. And so far, I think the message has really been that it's better than feared, but we should point out that expectations going into this results season have been relatively muted. On the positive side, as said, we're probably seeing less earnings downgrades than people expected, but there now are clear signs that the economy is beginning to roll over in places, and margins are beginning to crack around the edges. So that's certainly something we're watching.
Is the expectation then, given what you've seen out of these results, that margins, that rollover does start to happen as growth slows? Is that something you're going to have to start positioning for in the months ahead, the quarters ahead?
Absolutely, and many companies have ridden the coattails of rising inflation in the recent year or two, and as inflation is beginning to roll over, particularly on the input cost side, that's something that many companies are having to pass over to their companies. So something we're really watching for is the pricing power of those companies, whether they can maintain prices and margins, or whether that has an immediate pass-through effect to their customers.
Destocking has been a theme as well, particularly consumer companies destocking. Is there an opportunity now, given the value squeeze on some of these companies?
Yeah, destocking is a theme that's come up in many corporate earnings results so far, and it's really been a perfect storm for many companies because supply chains were disrupted heavily during the COVID period, which led many companies to overorder at a time when consumer demand was cracking. So we've seen destocking problems in the pharma sector, in chemicals, ingredients, and of course in the logistics sector. The good news, though, if there is any, is we now appear to be towards the end of that in some of these sectors. And that's something that many companies have called out during earnings season. And actually that one sentence or two calling the end of that destocking cycle has really moved earnings results for those companies that have highlighted that theme.
What is your take on what's been happening in Italy? Do you see this as kind of idiosyncratic to a populist Italian government, that they're going to have to walk this back in terms of this surprise windfall tax on Italian banks? They're gaining in the session today, but not recouping all of the losses of yesterday. Or does it remind us that there is a political risk across sectors in Europe, and you have to weather that, you have to position for that?
Yeah, I don't think that's purely a European issue. It's something we might see in other regions as well. And there's no doubt companies, and particularly governments, have to navigate this balance between populist measures and long-term structural reforms. And it's interesting to see the Italian government rowing back on some of those measures today as a consequence of the market reaction we saw yesterday, which probably surprised them slightly.
On the upside, you at Allianz have got pretty decent exposure to Novo Nordisk. That story is really fascinating. They're challenging now LVMH for being the biggest market cap company listed in Europe on the back of course, is this weight loss drug, and the results out yesterday in terms of the potential benefits around those with any cardiovascular issues. Talk to us about how you're thinking about the healthcare sector. Is there further to run in this? What is the best way to get exposure to the momentum that's building around some of these weight loss drugs?
Yeah, I think yesterday was an enormous day for not only Novo Nordisk, as you saw in the share price move, but probably more importantly, the obesity treatment market longer term. And as you rightly said, yesterday we had the data from the SELECT trial, which Novo Nordisk have been running for 5 years now. And that proved that people who take Wegovy, which is their weight loss drug, have a 20% reduction in cardiovascular events. And what that really does is it shifts the narrative away from these weight loss drugs being purely aesthetic, almost lifestyle type drugs, to something that can meaningfully transform the healthcare system. Because obesity is one of the biggest costs, and tangential to that, cardiovascular risk for healthcare systems. So I think that increases the pressure on many of these insurance payers to adopt coverage for Wegovy. And actually, if you look at obesity, it's a market that's hugely undertreated at the moment. There's 750 million obese patients in the world globally, and yet the addressable market in dollar terms is only $2 billion. So I think many people's expectation is that addressable market might be north of 50 billion by the end of this decade. So there's no doubt the market is opening up. Novo Nordisk are very much at the forefront of that, and it's something we continue to be very excited about.
So potentially a $50 billion market, which, as you say, is huge. Do you want to continue to play that via Novo Nordisk and Eli Lilly, or some of the challenger companies?
Yeah, I think Novo Nordisk is the way to play that at the moment. They're the only one with a drug that is available to the market, that has been through the various tests and trials. More will come, and as you rightly said, Eli Lilly are launching a drug likely next year. But this is a huge market, and there's room for more than one player. So our view is that hopefully Novo Nordisk and Eli Lilly dominate that market, but no doubt you will see competition emerge. But really the theme here is growing and opening the market, which has huge positive benefits for patients, but more importantly, healthcare providers and the cost of that to the system.
China remains, on a different topic, dominant in terms of one of the market themes. It was interesting to hear from Masayoshi Son, the team at SoftBank, yesterday, the CFO at least, there saying that they've started to de-risk in terms of, as they described it, in terms of their assets and their holdings of Chinese equities. How are you thinking about how much exposure you want to have to China? Do you want to have it via European equities? Are you concerned that, for example, luxuries and European autos are going to be, there's going to be further downside there? Luxuries, of course, perform very well. Is luxury peaking? How are you thinking about playing the China story?
Yeah, it's very different dynamics we're seeing in China at the moment. In Europe, all the conversations centre around inflationary pressures, whereas, as you discussed earlier, in China, it's very much deflation. How that is looking in terms of Chinese import and export demand is rather weak, but there are pockets of optimism. And you mentioned luxury goods. Do
you think luxury has further to run in China?
I think so. And in luxury, you're seeing the US slow down slightly, and you saw that in LVMH's results, but actually China's been much more resilient. So on a 2-year basis, China is up 45% now for LVMH's Chinese exposure. So it's something we're still optimistic about, and you have to look at the longer-term trends rather than some of these shorter-term cyclical factors, which will float around slightly.
Okay, Marcus, thank you very much indeed with the call there on continuing to have exposure to luxury stocks on the back of the longer-term play around China. And Novo Nordisk is the call from Marcus in terms of how you want to be getting exposure to the optimism around some of those weight loss drugs. Marcus Morris-Ayton, European Equity Portfolio Manager at Allianz Global Investors. Thank you. Sticking with healthcare then, Novo Nordisk, as we mentioned, shares taking a breather after yesterday's mammoth surge. We're going to bring you the story then behind the company as it closes in, as we mentioned, on LVMH as the most valuable stock in Europe. It's really fascinating. Stay with us for the details. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today. We are 23 minutes into the European trading day. You're seeing gains of around 0.7% across the European benchmark, with energy, basic resources, technology and banks leading the gains. On the downside, travel and leisure and personal consumption, two sectors that remain in the red. Now, the weight loss drugs Ozempic and Wegovy have propelled Novo Nordisk to become Europe's second most valuable company. The insulin maker's shares are taking a breather after soaring yesterday, as Wegovy showed a 20% reduction in heart issues in a closely watched study. But the firm's struggles to meet demand are raising questions. Can it hold on then to the momentum and live up to the hype? That is a question that has been explored by the team today in the Bloomberg Big Take. Let's bring in Bloomberg's Naomi Kreske, who covers European pharmaceuticals for us in Berlin. Naomi, it is quite the tale, the propelling of Novo Nordisk to the second largest, by market cap at least, company here in Europe. And the big challenge now has come in terms of the trial and the data coming back positive. How are you thinking about the implications for Novo on the back of this news?
Yeah, I mean, it really was a very interesting day yesterday for Novo, really a home run of trial results. And I think the question now is really, can they overcome some of these issues that they've had with production? Can they really keep up with demand for this medicine? Demand which is probably going to increase even more on the back of these trial results from yesterday.
What makes this company, Naomi, unique?
It's so Danish in so many ways. It's controlled by a foundation. This has given it a lot of stability. It has a 100-year history after bringing insulin to Denmark about a century ago. And it's a place that, hasn't had a lot of different CEOs. It hasn't had a lot of kind of corporate drama. They also have a very strong work-life balance at their headquarters. Employees will be gone for all of July on vacation. So it's a really unique place.
Yeah, I love that. I love that line. It's just so Danish. And yeah, as you say, in our reporting then, the fact that most employees may have missed all of the action, at least recent action, given that they're all on holiday or have been over the month of July. What are the potential, Naomi, what are the potential downsides? What are the potential risks then?
I mean, this production issue, is something that investors, I think, will really be watching closely. The question of whether they can really capitalize on this first mover advantage that they have, being first to market with an approved weight loss drug that is this effective, that has also shown, the heart benefit that was shown yesterday. It's really a question of I suppose, execution at this point.
Okay, Naomi, really fascinating read, the Bloomberg Big Take. Naomi's Kreske, of course, Bloomberg's Naomi Kreske on that Big Take and what it means for the future of Novo Nordisk on the back of the upside that they've seen. Really worth checking out, of course, NI, Big Take Go on your Bloomberg terminal and on Bloomberg.com. Coming up, the Italian story around windfall taxes. We'll get the details and reaction. This is Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today. We are 30 minutes into the European trading day. Here are your top stories. Banks reversed some of yesterday's steep losses as Italy says the impact from its surprise levy on lenders will be limited. European stocks and US futures climb, brushing off China's slide into deflation, while Treasury yields drop after a positive 3-year note auction. Plus, Novo Nordisk shares take a breather after yesterday's surge as it closes in on LVMH as the most valuable stock in Europe. Let's check in on these markets then on a day where there is a little bit more optimism across these markets and recouping some, not all, some of the losses in the banking sector of Italy on that clarification, let's put it that way, generously. If we're being generous to Italian politicians and the leaders over there, of course, in Rome, then the clarification around the surprise windfall tax. Across the benchmark then, you're seeing gains of 0.9%. Here in Europe this Wednesday morning, the DAX is up 142 points. Here in the UK, the FTSE 100's back above 7,500, 7,581, a gain there of 0.7%. And a look at your sectors, with energy leading the gains, despite the concern about the deflationary impacts out of China, the fact that they're sucking in fewer imports, of course, on that weaker, sluggish domestic demand and those soggy imports. Energy is actually performing fairly well this morning, leading in terms of your sectors, up 1.5%. Technology also getting a bit of a bid, gaining 1.4%. And of course, banks coming back again on the back of the news that Italy has said that actually this tax windfall is going to be limited. We'll get more of the details on that story in the next couple of minutes, and the analysis as well from someone who is in the weeds on the banking sector. But that sector currently gaining 1.3%. Let's get a check then and the pulse on some of the individual stocks on the move with none other than Joe Easton. Joe, what is standing out to you at this point?
So TPI cap, Tom, now up around 13%, heading for its best gain in around 3 years. I'm feeling pretty pleased with myself for picking this one pre-market for stocks to watch. That one, as I say, 13% gain. This is as their brokers report an increase in the amount of revenue per head that they're making in the last quarter for the world's largest inter-dealer broker. I get the occasional stock correct pre-market. Now Flutter, this one dropping almost 5%. The UK, as I say, strong. The Brits still gambling a lot, but the Australians not gambling as much, according to the company. And that one is falling over in Dublin, the worst performing stock on the Dublin Exchange. Doing pretty well in the US. They've got the FanDuel business, which is focused on American football, baseball, that kind of thing. But it really is that Australian outlet hitting that stock today. In terms of the grocers, we've got Ahold Delhaize. Now, this company has around 7,000 stores. 60% of their revenue is over in the US, but it's listed in Amsterdam. Some weakness in their margins, some of their costs still not coming down. That one falling 3%, despite pretty strong sales that are boosted by rising food prices, of course. In terms of autos, Volkswagen is one of the few auto stocks gaining today. Upgraded at Citi, who say that stock is too cheap to ignore. They've downgraded 4 car makers, including Stellantis, saying that consumers will start cutting back on the amount of money they're willing to spend per month on new vehicles. But they rate Volkswagen and also Renault buy, and both of those stocks gaining more than 1% today. Then we're going to look at Italian banks. Now, I'm not going to lie, your next guest is going to have to do the heavy lifting on the details for this one, but those stocks are rebounding. Fineco Bank, Unicredit, Intesa San Paolo and BPM. That one, the former Banco Popolare. Those ones all rebounding after gains of getting my gains and losses mixed up. Huge losses yesterday, almost 10% for some of them. Unicredit was down around 8%. We've had that news overnight that this will be limited to around 0.1% of the assets of those companies in terms of how far this tax can go. So that's a bit of a relief, but it could still shave off their earnings. But we are seeing a rebound in Italian banks this morning. So that one moving the FTSE MIB index higher this morning, Tom.
Yeah, recouping some of the losses of yesterday. Joe Easton, thank you very much indeed, of course, from our equities team. Let's stay on the Italian banking story then. The whipsawing for these stocks on the back of the policy moves out of Rome. Let's bring in Ottavio Morenzi, co-founder and CEO of Oppimas, who is always excellent on the banking sector. Ottavio, thank you for joining us. You described this move, this windfall tax, and it was a surprise yesterday, clearly, as a big mistake. Why? They've been making profits, and if you want to fill the fiscal coffers of Rome, this is one way to do it.
Absolutely. If you need to raise taxes, it's an obvious place to go. It does seem a bit sort of capricious and unfair, and to do it just sort of at the last minute without any sort of advance warning. It's also sort of a retroactive tax in that it's a new tax that goes back to the beginning of 2023 and you'll get taxed on that. But I think it is a mistake because it sort of sends a signal. If you as a firm do well in a particular quarter or year, we're going to come back and look at that and increase the taxes further beyond it. And it's a really peculiar tax in the sense that it targets just net interest income. I mean, what happens if your trading investment banking activity does particularly well in one quarter or 1 year? Are they going to come back and say we're going to take 40% extra of that or 50% extra than that? Should pharmaceutical companies be taxed for the extra profits they made during COVID? Should defense contractors be taxed extra for profits they're making during the Ukraine war? I mean, there's all sorts of scenarios that you can think of, but it creates a level of uncertainty, I think, for the Italian banking sector, and I think for Italian equities markets more broadly. So I think it's a mistake on that front.
Are you in any way reassured by the clarification that's come through from the Italian government around the fact that this will only apply to a limited 0.1% of assets held by these banks? Are you reassured at all this morning, Octavio?
Well, certainly that means that tax is going to be lower than we'd originally thought. So yesterday we thought it was much bigger. But let's look at what that really means. So if we look at one of the big banks like Intesa, they're generating about 8 billion euros now net interest income. They look on track to that. So 40% of that would have been an additional 3.2 billion euros in taxes for that firm. They have about 1 trillion in assets. So what do we think? It's about 1 billion. So they've reduced basically this potential tax from about 3 billion on Intesa down to 1 billion. So that's much, much better. That's much more reasonable. I am concerned by the Italian authorities coming out with such conflicting news in such rapid succession. I think they were a bit surprised by the reaction of the markets. They said, oh, no, we can't do that. Well, let's clarify that and find some other way that we can limit it. Rather than take it down from 40%, we're going to take it down to 20%. No, we're going to do it by putting a cap based on assets. So they've got kind of a complicated formula in there. But what I do expect to see Italian banks do now is to respond to this and basically start to hide interest income as fees and commissions on things. So they'll basically say to you, well, that mortgage that you're paying 7% on now, we'll actually give it to you for 5%, but there's a 2% processing fee. So they're going to be playing sort of the three-card Monte shell games, trying to hide interest in as commissions or fee income and things like that. And that's going to take a lot of effort on their part. They're going to revamp some of their contracts and go back to when they go into loan origination to jigger things that way instead. So it's going to be a chasing game and hide and seek a bit in terms of those revenues. But I expect the Italian banks to do that in the coming months and in the coming year, basically.
Does that suggest that the sell-off of yesterday was overdone then?
I thought it was actually quite restrained, given everything that was coming out. I mean, so they said a 40% tax on net interest income, which is bad. That's really bad, as I pointed out. That's a multi-billion euro hit for the big banks in terms of that. But I think there's uncertainty too in terms of what comes next. I mean, why stop there? Why not go further? You can only squeeze so much money out of the banks, and they start to suffer. So I think that's the uncertainty of it, I think, is concerning as well, that you're not really sure what the authority is going to do. And this rapid change in terms of positioning, I find that disconcerting as well. I don't find that reassuring, really. I mean, obviously the tax is going to be lower now if they stick to this new number, so 40% capped at 0.1% of assets. But it's a bizarre formula to put in place, and it's very disconcerting that they change so rapidly and so easily. I'm not sure what's going through their heads.
The argument that the flip-flopping then from Rome is just really kind of underscoring the uncertainty. When it comes, interestingly, of course, we saw Spanish banks as well falling on the back of this news yesterday. We have a viewer question, Octavio, asking whether it is your expectation that other policymakers in Europe, other governments, may be considering a similar windfall tax.
I'm sure politicians all over Europe are considering additional taxes in all sorts of places, and the banking sector is an obvious place to come with it. I think now, given the Italian experience and the impact on the stock market that they had, they're going to be much more cautious about doing this and coming into it. And I think they're going to try and announce it beforehand and not suddenly come out with a new tax that's quite substantial for the banking sector. So I think they'll be more cautious. There's going to be a very strong temptation to follow suit, though. Politicians in Europe tend to sort of follow the leader, and once one of them does something first, the others tend to follow. So I would expect, yes, we'll see similar things coming out of other European countries. Spain is a prime candidate. The government there is running serious deficits. They're going to need additional cash, and the banks are sort of the golden goose that is going to lay those eggs for them. But no, so I think we will see other European countries do that, but I think they're going to be more cautious now, given the Italian experience, and seeing that the Italian government was forced in sort of a very humiliating, embarrassing way to sort of back down from it quite substantially.
Octavio, over in the US then, we had this downgrade of some of the lenders by Moody's. Was this kind of backward-looking action from this rating agency, or are they flagging risks that the markets continue to overlook?
Well, I suppose better late than never. You know, we saw all these things unfold in the regional banking sector in the US in March. The ratings agencies were relatively silent at that stage in terms of it. They certainly given us sort of advance warning of that happening. But I think the balance sheet stress there, on the one hand, has not gone away. We're seeing interest rates keep going up. We're seeing an inverted yield curve. That's going to put pressure on the banking net interest income in due course in the US. It hasn't yet, but I think that will happen over the course of the next couple of quarters, so we'll see that. So there's definitely going to be pressure there. The other question is what happens to the real estate portfolios, in particular commercial real estate portfolios at these regional banks where they have very large exposures. So far, those things have held up pretty well, surprisingly well. Actually, default rates on commercial real estate remains quite low. The valuations have come down, but they're not defaulting on the loans just yet. The thing that has changed quite substantially since March is that the Fed has stepped in and basically put into a term funding facility that is very, very generous to these regional banks and allows them basically almost unlimited access to liquidity by basically saying, we'll lend you money against the original value of your securities, of the things you hold in your portfolio. So I think that basically takes a major part of the risk off the table. So I think Moody's reaction here is basically almost sort of a day late and a dollar short in terms of warning us. It would have been good if they told us before all these banks went belly up that there was a problem rather than a few months later.
Okay, I like that
other thing that I find
pithy analysis, a day late and a dollar short. Sorry, I cut you off, Octavio. What else do you find interesting in?
Well, the other thing that's really interesting about it is that they put certain banks on sort of a watch list and say we might have downgrades for these banks in the coming months. In particular, sort of the three big custody banks, Boney Mellon, State Street and Northern Trust. Now, if you look at the financials of those firms, except for Northern Trust, they're growing, they've got healthy profit margins, they seem to find Moody's seeing something there that we're not seeing. So I'm curious, I'd be curious to see what their reasoning is to put basically State Street, Northern Trust and Boney Mellon on the watch list. Those firms tend to have pretty boring sort of securities processing businesses where they don't take large exposures, they don't take large bets on lending. Lending is sort of a smaller part of their business overall than other banks. So I'm a bit confused by that. I don't see a strong rationale and reasoning for the watch list warning there.
Okay, Octavio Morenzi, really appreciate getting your analysis and your take on what's happening, of course, across Italian lenders and the banking sector in the US. Co-founder and CEO of Oppimas, thank you. Coming up, Continental cuts its sales outlook for the year on weakening markets for tyres in Europe and North America. We're going to be speaking to the CFO, Katja Dürrfeld. That is next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Welcome back. This is Markets Today. We are 45 minutes into the European trading day. A little bit of optimism in these European markets in terms of catching up with some of the selling of yesterday, making up for some of the losses at least. 0.9% is the gain across the European benchmark, the Stock 600. Energy is the sector that's leading right now, up 1.6%. Just one sector in the red, that is travel and leisure. Let's get back to some of the macro, though, and so far, so good. That is essentially the basic assessment for this week's historic Treasury debt auctions. Tuesday's $42 billion sale of three-year notes produced a lower than expected yield, so good signs, of course, for the Treasury, and a sign that demand was actually stronger than anticipated. Today is another big day. Let's bring in Bloomberg's Valerie Teitel then. Valerie, last week's Treasury weakness has seen a decent reversal since Friday's payrolls. The auctions are key, though, and particularly with the benchmark, with the 10-year later today.
Yeah, that's right. The three-year auction was really quite stellar last night. But I think the real test really comes for this long-end paper we get. We get the 10-year tonight and the 30-year auction later on Thursday. More attention is on the long end, Tom, because it really led the weakness in the Treasury market last week on the back of this Fitch downgrade of the U.S. Treasury market and the U.S. Treasury just announcing these larger auction sizes and announcing they're going to be issuing $1 trillion of debt just in the third quarter alone. So a lot of attention on the growing U.S. debt pile. And let's see if this 10-year auction tonight, even though it's bigger than what we thought it was going to be, if it gets off on a solid footing.
Okay, so we're talking about government debt, of course, Treasury debt, their ability to refinance and load up in terms of the ability to continue to finance the spending plans of the government. Meanwhile, and the consumer in the US has remained relatively robust. Some of that is clearly falling on credit cards. What is happening in terms of the credit card debt of US consumers? Is that also something of a concern now?
It's definitely rising. We had a quarterly survey out from the New York Fed yesterday that showed credit card debt in the US reached over $1 trillion. It set a new record. It's the first time it's been over $1 trillion. And then if you look
it's never been above $1 trillion.
Never been above $1 trillion. For the first time, it crossed that threshold. And then for US households as well, total debt of U.S. households also reached a record. Now it's $17 trillion. So those numbers might sound eye-watering, but the good news in this survey was that delinquency rates are still quite low. They dropped to really tight levels during the pandemic because of all the stimulus payments these consumers had, all the cash the consumers had on hand. And they have been normalizing somewhat, but we're not seeing a worrying rise in delinquency rates just yet. But the worrying thing is, the bigger the debt pile is, the more trouble we do get into if delinquency rates start to creep up.
Okay, so record borrowing on those credit cards in the US. Valerie Teitel, of course, and looking ahead to that auction of US 10-year US Treasuries later today, the importance in terms of whether or not there is still that demand. Thank you, Valerie. Now, coming up so far So good. As we mentioned, we do have that Treasury auction. That's coming up later, of course. Valerie has just teed that up for us. It is, of course, consequential in terms of the US Treasury's ability to continue to finance some of these spending plans and whether or not there is that investor appetite to snap up and hoover up those 10-year Treasuries. Yes, yesterday was pretty positive. We'll get more, of course, in terms of the earnings picture as well. Continental and the CFO on the back of an earnings miss. We will be speaking to the CFO of that German auto parts supplier. Stay with us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back. Now, Continental has cut its sales outlook for the year on weakening demand for tyres in Europe and North America. Pleased to say I'm now joined by Continental's CFO, Katja Dürrfeld. Katja, good morning. Let's start with that weakness then that is percolating through the European and US markets for the tyre division of the business. Do you expect that weakness to continue in the quarters ahead?
Yeah, so Mark, we've already seen weakening demands in the tires business during the course of the later last year. So the second half of the year, demands were already lower than in the first half of last year. And we do see this weakness to continue throughout this year. And this is the reason why I've reduced our tires replacement business outlook by around 500 million in sales. Nevertheless, let me confirm at this point in time that we do stick to our margin forecast. So despite the fact that we've lowered the expectations on the tires business replacement, we still stick to the margin forecast, which shows how well we are positioned with regards to our pricing in the market at the moment.
Okay, so you stick to that forecast around margins. In terms of the inflation, the input costs, transport logistics clearly has been a challenge, Katja. Is that still the pinch point, the choke point for you? Is it transport, and when do you see those issues being resolved?
When you look at our overall cost inflationary guidance for this year, we've lowered our expectations on cost inflationary headwinds from originally 1.7 billion to 1.4 billion. We still stick with the 1 billion that we've originally laid out for the automotive business because there the majority is coming still from material input costs, especially from the semiconductor and electronic component business. When you look at the tires inflationary headwinds guidance, we've lowered expectations from originally 400 million to 200 million. Those 200 million on the tire business are solely related more or less to wages and salary increases, inflations that we do see during the course of this year to happen. And when you look at the quantitative business, we've also lowered our expectations there by 100 million. And this is mostly due to the fact that we do see less impact, especially from the logistics that you've just announced on our cost basis in the business. So overall reduction from 1.7 billion to 1.4.
Katja, how much demand are you seeing out of China? I'm thinking particularly of the auto unit for Conti. What percentage of sales is coming out of China, and how much demand do you expect to see out of that economy in the quarters ahead?
So when you look at our overall exposure, we've published figures last year where we said that in total 12% of our sales are in the Chinese market. In fact, when you look at the outperformance that we had in our different markets, especially on the automotive side, you've seen that we have done quite well in the Chinese market. In the first quarter, we grew significantly above market growth in the first quarter, and in the second quarter, we grew in line with the market. So overall, China is a relevant market for us in Continental, and we're happy to see us growing with all our customer base there, not only with international OEMs, but also especially with the Chinese OEMs.
And staying on the China story, Chinese EV makers are expected to kind of double their market share potentially in the next 3 years. How do you expect that theme to impact your business, to impact Continental and the demand for some of those units, some of those products focused on EVs?
Okay, let me first point out something that is of great relevance for us in Continental is that our current product portfolio is not that much dependent on the powertrain, also our future product portfolio, by the way. With the spin-off of Vitesco Technologies, we got pretty much independent with our product portfolio from the way the car is driven. So if it's an electric or a combustion engine, does not matter that much to us anymore. All cars need tires, all cars need brakes. The displays that we've developed for the market, all the autonomous driving solutions, all those are relevant for no matter what powertrain drives the car, in fact. So overall, with the new cars and with the new vehicles and with our strong position that we've built up in China, we do expect us to grow with the market or outperform the market even with the products that we bring.
Okay, further growth potentially out of China. Continental CFO Katja Dürrfeld on the back of those earnings. Thank you. We appreciate your time this morning. The stock up 0.9% so far in the session. You're looking at optimism across European equities, gains of 0.8%. That is it for markets today. You can get more insights, of course, on the website. Stay with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here is what coming up on today's program. Italian banks claw back some of yesterday's losses as the government says the impact from its surprise tax will be limited. China slides into deflation as a property slump, plunging export demand and subdued consumer spending weigh on the recovery. Plus, Amazon said to be in talks about becoming an anchor investor in the IPO of UK-based chip designer ARM. So good morning, everyone. We still have a packed show despite being a little bit thin on news for August, but we look at Novo Nordisk, we look, of course, at Treasuries, we look at CPI later tomorrow in the U.S. This is a picture across the board for some of the markets. You can see the FTSE gaining some 0.7%, the CAC 40 gained 1.3%, the FTSE MIB in Milan. It's interesting because it's gaining 1.7%. So we'll have a full roundup of what's happening with the Italian banks. The finance minister really yesterday walked it out with a statement trying to put a little bit more meat on the bones about what this tax in terms of profits this year for the banks really meant. Yesterday they freaked out, bank stockholders. Today they're appeased somewhat. A lot of the banks are gaining some 0.3%. If you look at 10-year Treasury yield, now this is a big one because we heard from Patrick Harker also that the central bank, the Fed, could actually stop raising rates but then keep them at this level for a lot longer. So we see the actually resilience of some of this 10-year also after we had a bond auction yesterday that was oversubscribed. You can see we're holding up above 4%. So I was talking about the Italian banks, so let's have a look at what they're doing overall. I think they were gaining about 3% yesterday. A lot of them were actually slammed. The two biggest ones you can see, Intesa Sanpaolo and Unicredit, that were down between 8 and 10% yesterday, are now gaining 3 and 2%. So Italy has issued this clarification on its surprise bank profit windfall tax after lenders had some $10 billion wiped off of their value. Well, joining us now with more is Bloomberg's Alessandra Migliaccio. So, Alessandra, thank you for joining us. I mean, it's incredible that they waited actually 24 hours for the clarification. But what's been said and what does it actually change?
Right. So it is a bit crazy. I mean, we noticed that as well, obviously. I think what happened is there was a surprise announcement initially from what we're told by sources. The finance ministry wasn't really planning on announcing this soon. There was talk of some kind of tax on banks, but Salvini, who was the deputy prime minister, really wanted a show right before vacation. He wanted to talk to his electorate. He wanted to do something for the people. He's very much a populist element of Meloni's government. And then the next day, the finance ministry had to pick up the pieces. They had to get their staff together. They had to decide how this 40% tax was going to work. And I think when they saw the bank route, they decided, yes, okay, let's do it, but let's, put in certain things like that it won't exceed 10% of the firm's assets and such, to explain to the markets that it's going to be a tax, but it's not going to be quite as bad as initially it seemed from Salvini's statements.
Yeah, so Alessandra, what actually needs to happen next for this to become law? First of all, we had a similar situation in Spain where a lot of the banks are also taking legal action, and this has to be voted through Parliament.
Yeah, so this is very interesting. I mean, it looks like, all this is, a lot of this is we're basing on sources that we're speaking to, both within the banks and the finance ministry. We do know that the law, it needs 60 days, then it goes through Parliament, as you said correctly, and then it could get changed. There are a lot of lobbies, there are a lot of different opinions in Parliament. Also, the banks could easily go to the courts, and because it's retroactive, there's a lot of things that are a little bit fishy about it, and they might not have to pay, or the money might be given back at some point. This has happened in the past. But it's very much political, so, we'll really have to see what happens. I think in some ways, Meloni knew that she had to give Salvini something, and he's happy. He got his result. He showed his electorate he cares about them. But then, it leaves everybody else to pick up the pieces.
Yeah, very well put. Alessandra, thank you as always. Alessandra Migliaccio, they're joining us from Italy now. Also joining us to discuss what's happening with the Italian banks and in general, the strength or weakness of the European economy. PGIM Chief European Economist Catherine Neese and Bloomberg's Justina Lee. So thank you both for joining us. Justina will look at the markets. And Catherine, you really look at some of the economics, underlying strength of weakness of some of these countries. I mean, this tax on banks really came as a surprise, and we saw the immediate reaction of shock in the markets. Was this a mistake? Could it be of future things to come? So how do you see it as an economist?
It's not a great signal. I think so far the Meloni government has been seen as being very investor friendly. So this was a surprise and not in a good way. And I think it will raise question in investors' minds if banks, what could be next? And of course, we have to remember this is happening against a backdrop of weakening growth. We had a very poor picture for economic activity in Italy in Q2, and it will just raise some question marks in investors' minds.
Yeah, and there's also this question about the NPRR, the fact that that they haven't fully met the criteria to access the funds, of course, of the European Union. Do you worry about Italy right now? Yesterday, we were also looking at the spread between Italian, BTPs and German bunds, but they didn't widen. Is there a danger that they do as we get into the winter months?
I think that risk is going to be ever present so long as Italy has very high debt to GDP. I have been very positive on Italy and on the periphery more generally for exactly these reasons that you mentioned. They now benefit from huge EU backstop measures that were not there in the years before the pandemic. And that is really pretty much hardwired in for the years to come. That said, fundamentally, if Italy wants to get its debt to GDP ratios down sustainably, it needs to grow, and that, I think, more attention is going to be focused on that in the coming months as we see the region slowing, and so that could cause some of these risks to bubble up and crystallize.
Justina, does this have longer-term market implications? I mean, we had some great story and great coverage on the Bloomberg terminal, and we also had some really funny pieces. I mean, most Italians, I'm Italian, are at the beach in August, and they had to recall basically bankers from the beach to deal with this sudden shock.
Right, exactly. It really is pretty funny and a surprise, as just mentioned. And I think one interesting thing is, obviously, we always think of banking stocks as a cyclical kind of sector. But what cyclical means is that in the good years, you do expect to do better, as we have seen. But it's kind of funny that now the good years are not looking as good anyway.
But I guess it changes the banking model. I mean, I was interested in what they said yesterday, which is, look, if you're passing on these higher interest rates to depositors, you'll be pretty much fine. So this is a populist move also to make sure that the banks pass on some of their benefits.
Yeah, that is true to some extent, because we have seen net interest income at these banks rise as well. I think the longer-term question for investors is, if this risk is always present, does it mean generally lower valuations for banks going forward? And that could be something that could affect their cost of capital, which means ultimately it could kind of have this effect longer term. But I think it kind of depends on how the Italian government is now, presenting this message to investors.
Yeah, and Catherine, we're hearing, without speaking about the banks specifically, but we hear politicians, right, go after the banks because they're not paying depositors enough. And that, of course, would help with consumer spending. It kind of helps with what you're dealing with keeping the economy quite strong, even when interest rates rise. Are we going to see a change in consumer saving and spending as this shift happens?
It will be one factor, I think, that will feed into consumer sentiment. You know, as you said, this issue around interest rates is wider than Italy. We saw it here in the UK with the FCA having meetings and making some moves in that direction. But it's just one factor. There are many things that are weighing on consumer sentiment and plans around spending. You know, clearly the cost of living crisis is a major one there. And I think as we see some of these price rises that we've been experiencing for more than a year now start to ease and come off, energy and food, I think that is likely to be a more important factor behind consumer sentiment than some of these other things that you've discussed.
Yeah, and we'll talk a bit more about consumer sentiment in Europe, but this is the big number. So we started doing this week, and actually thank you to Dan who puts it together. This is our big number of the day. It's $63 billion, and it's basically Novo Nordisk's gain yesterday in the market value, and this all has to do with one drug, Justina.
Yeah, exactly. It's all about the weight loss drug Wegovy. Now, we've already heard a lot of hype about this drug, but what kind of the results yesterday showed was that it actually also reduced heart disease risk by, you know, around 20%. And even to analysts who kind of already knew about this drug, they said this is almost the best results you could have hoped for. Because what it means is that it really expands the market for this drug and also makes it more likely that maybe more insurers will reimburse, you know, the users for it.
Yeah, and so we have a big take on Novo Nordisk, and then we're excited we're speaking to the chief executive tomorrow as well. So we'll be back with Catherine Neese from PJ and Bloomberg's Justina Lee. Both stay with us, and we'll talk a lot more, of course, about the European economy and what possible China deflationary impact can have on this region. The other story we're following is WeWork falling some 17% in pre-market trading. This is on ongoing concern and doubt about the viability of the company. So we'll have plenty more on WeWork as well. Coming up, the world's second largest economy slides on deflation. We'll bring you the latest on the China inflation data and economic recovery. That's next, and this is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Now, the conversations that matter, the insights you need. This is a Paul Sanfrancin-Lacqua here in London. We're just getting the pre-market trading for WeWork falling some 17% in pre-market trading. This is on ongoing concern about, and doubt about what happens to this company. So the company has raised serious concern that it could go out of business. I have to say, yesterday, the stock already plummeted some 24% in extended trading on the news. This was one of the rowdy co-working startup that was transformed into a stable, profitable company, and at least that's what they've been trying to do. And there are now real questions about it bleeding cash, customers of its office rentals canceling membership in droves. And so that's what WeWork said in a statement yesterday. And you can see it'll probably pan out in the next couple of days as we try and figure out what happens. If you look at bonds, actually at WeWork, they're also at deeply distressed levels. Now, China's consumer and producer prices both declined in July from a year ago, a sign of deflation pressure as demand in the world's second largest economy weakens. Joining us now for more on this is Jill Daisis in Hong Kong. Jill, good morning, or good afternoon actually for you. What are some of the key takeaways from this data?
Yes, so I think the biggest takeaway here, looking past the factory gate prices, which have been in deflation for, I think, 10 months now, that consumer price deflation was certainly very concerning. So that was, I think, the first time that we've seen that metric fall into deflation since early 2021. This is the first time since late 2020 that both of these metrics have been in deflation. I think, at this point, remember, back in 2020, 2021, right, when, we were dealing with really the heart of the pandemic, and some price pressures there. Now that we're into 2023, we really thought that China's, we were expecting, the consumption to drive the recovery for people to start spending money. And so what this is indicating is that even though a lot of that impact on that CPI gauge is coming from really volatile food and energy costs, if you look at the core CPI number, it's actually up year on year. This still kind of indicates that, there's a lot of issues with household consumer confidence in China, trying to convince people to spend money, and then it really sort of spells, I think, from economists, more of an urgency for the government to try to do more to boost consumer spending, to get people to start spending money, to get economic activity going again through the rest of the year.
So, Jill, this program has been a bit obsessed with Country Garden, but how much should we really worry about it? I mean, if there's a default, at the moment they have 30 days to pay the coupons that note holders haven't received on Monday. If it goes into default, what does it actually mean?
Yeah, so so looking at Country Garden, back to this whole issue of China's economy in general, that has, looking at the property crisis, right? So Country Garden is China's 6th largest developer by sales. The idea that it's missing payments is certainly very concerning for the company's liquidity, possibilities for failure. This is all part of this ongoing years-long story we've been telling about the property crisis in China. What does that actually mean? I think that the problem with Country Garden is that, again, because it's such a large developer, that means it has a lot of very active projects. And so, you don't want to see a company of that size in China failing right now, because, that could have ripple effects across the rest of the property market. The government has been spending some time recently. I think some of its most robust policies for economic support this year have been focused on the property sector, trying to help, companies meet financing needs, that kind of thing. I think that, though, that this Country Garden incident just spells, that the concerns about the property market are not ending in China. We still have a lot to worry about before we see that kind of pick up.
Jill, thanks so much. Jill Daisis there for us in Hong Kong. So we're back with PGIM Chief European Economist Catherine Nice and our very own Justina Lee. Catherine, when you look at some of, I guess, the concerns in China, so are we importing deflation from China?
I think the big concern for Europe is going to be that the weak inflation picture in China, as you've just discussed, is a reflection of weak demand. And weak demand in China means weak demand for European exports. And exports matter hugely for Europe, more so than for an economy like the US. And given that the economy in Europe is not strong at a domestic level, we can see that consumers are not firing on all cylinders. If external demand is weak as well, what what is there to hold up these economies? I think that is the question mark and the concern that Europe is going to sort of move back to a situation where it's basically flatlining when it comes to growth.
And just, what's your take on country garden, which I keep on mispronouncing? I mean, I keep on calling it garden country, which I'm not sure why it looks like a meme, at some point from like 2001 in the US. But what does it mean for the rest of the world? I feel like the market is very cool about what's going on, and yet they were freaking out about Evergrande.
Yeah, exactly. And in fact, Bloomberg Intelligence analysts actually said today that a country garden default would be worse than Evergrande because they actually have 4 times more projects. And I think, for now, there is a bit of a kind of a grace period for it to pay back its bondholders. But I mean, the fact that it's even using that grace period and maybe waiting for the liquidity to come, I think that's a very bad sign.
But why is the market so cool about it, Justina?
Yeah, I think maybe it's already used to all the bad news from China. I mean, even today's kind of reaction to the deflation numbers, I mean, even that hasn't been too negative. I think the market is really waiting to see if the Chinese government will ease kind of property measures further, as they have promised to do.
Yeah, so we haven't really seen, we don't think there's a direct link, right, if there's a default of this company to Europe, but it would, I guess, kickstart some kind of mechanism, maybe with PBOC involved. And so that could change some of what happens in Europe, Catherine.
So the indirect linkages between China and the rest of the global economy are far bigger than what the direct linkages would apply. The UK is a great example. We don't tend to trade very much directly with China, but if China is really going to slow, that's going to have a huge impact on the UK economy. Why? Because it matters, as we just discussed, for Europe, and Europe is the UK's largest trading partner. And so these indirect linkages are going to matter hugely. And even in terms of looking at financial market linkages, what we know from the economy is in China is it tends to be, less correlated with other financial markets globally. But when things move sharply, you tend to see these correlations increase. So I think there is always a risk that if we have, big moves, that could then lead to some contagion effect.
Yeah, we always underestimate maybe some of these linkages. Catherine, thank you so much. And thank you to Justina Lee. Catherine actually stays with us. She's from PGIM, where she's fixed income European economist. She stays with us, and we'll talk a lot more also about the Fed linkage with Europe. But we'll do Fed, and of course we'll do Bank of England next. This is Bloomberg. So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain. There's a lot of talk over the last few weeks about the potential for what is often called a soft landing. Certainly last month's inflation read was a good one, and I hope it's a sign. Because, to be sure, the Fed's objective is not to cause a recession. It's to reduce inflation in line with our mandate.
That was the Richmond Fed President, Thomas Parkin, on the fight against inflation. Now, PGIM Fixed Income's chief European economist, Catherine Nice, is still with us. Catherine, when you look at what's happening in the U.S., so there does seem to be a shift, and this could also be true from the ECB and the Bank of England, of, look, we're almost there on interest rate hikes, but then they'll stay here for longer. I mean, what does Fed policy, what does that mean for ECB? How much do they look at each other?
I think the ECB is really setting rates for the euro area.
Course,
and Lagarde has emphasized that the macro situation in the euro area is quite different from the U.S. In the U.S., the primary driver of the bout of inflation that they experienced was coming from very tight labor market, very strong economy, whereas in the euro area, it was primarily driven by these energy prices. So that does mean sort of horses for courses when it comes to policy. That said, I think that general trend of being pretty much there when it comes to peak rate, with maybe some fine-tuning around what that means, is a common theme across both the ECB and the Fed. And they've both been very clear that they don't see, a big series of cuts anywhere on the horizon.
Catherine, what's your take on Bank of England? I mean, I feel like we're in a juncture, right? I mean, we always say the BOE is in a juncture, but they could either, mess it up or be okay with the economy. Like, what do they do next?
So it looks to me like the Bank of England does have a bit more road to travel when it comes to higher interest rates. If you look at some of the near-term trends in underlying domestically generated inflation in the UK, it looks very concerning. You definitely do not have this clear and compelling picture that things are coming off like you do, for example, in the US. And that suggests that they do need to do more. I think most people are expecting a couple more 25 basis point hikes. But I think there is a risk. It's a long time between now and their next policy meeting. Yeah. If the data surprise again to the upside on inflation and wages, then,
it could change.
Things could get chased higher.
Thank you so much, Catherine Nice.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Italian banks claw back some of yesterday's losses as the government says the impact from its surprise tax will actually be limited. China slides into deflation, a property slump, plunging export demand and subdued consumer spending weigh on the recovery. Plus, Amazon is said to be in talks about becoming an anchor investor in the IPO of UK-based chip designer ARM. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. A lot going on, actually, for what is supposed to be a very quiet day, a Wednesday in August. This is what we're looking at. First of all, the Italian government definitely backtracking what we heard just 24 hours earlier. They backtracked on part of this new windfall tax on banks, saying it would introduce a cap to limit the impact for many lenders as it really tries to calm a market rout that wiped out $10 billion from the bank's market value. Now, the levy, we understand because the finance ministry put out a statement late yesterday, the levy will not exceed 0.1% of a firm's assets. And we also understand that banks that have already increased the interest rates offered to depositors will not have a significant impact as a consequence of the rule. So today, after losing about 10% each, maybe 8-9% each yesterday, Intesa Sanpaolo and you can tell Unicredit gaining between 3 and 4%. Now, let's talk about a Bloomberg scoop. L'Occitane's controlling shareholder is said to be in advanced talks on a potential deal to take the skincare company private at a valuation of around $6.5 billion. Now, the move would add to a series of similar deals in Hong Kong as valuations remain depressed. Joining us from Hong Kong is our Bloomberg news reporter who always breaks news. He's Manuel Baigorri. Manuel, it's been too long. Thank you so much for coming on. So why are we seeing this deal now, and what's the rationale behind it?
Hello, Francine. Great pleasure to be on the show again. Yeah, it's super interesting, right? And we're seeing a slew of deals here in Hong Kong where valuations are really depressed. I mean, the Hang Seng Index is performing pretty poorly compared to other global indexes, and that is leading to some take-private transactions. Definitely a bright spot for M&A on a very soft market for deal making globally. So here we go with L'Occitane. Global brand, very well known and traded in Hong Kong. PE ratio very, very low. And as we've seen with other transactions, the founder, the owner, majority owner of the company is, taking this opportunity to potentially take the company private. He's lining up financing and about to launch an offer for the company. So we've seen this in the past several weeks with other transactions, and we're likely to see more of those.
So, Manuel, would it make sense for some of the global firms listed in Hong Kong to be taken private and actually relist somewhere else?
Definitely. I think that's the rationale, Francine, behind these deals. Is like the owner, takes control of the company, takes it private, restructures the business a little bit, and then with the idea of relisting it somewhere else. We've seen some companies already thinking about that, potentially, listing them, say, in mainland China or back in Europe. I think this could be an ideal candidate for such a move, and potentially either selling it or relisting it at a higher multiple.
And Manuel, is financing supportive of such deals?
Well, we've seen financing becoming a big issue, right? For the past 12, 18 months, the financing markets have completely been shut. I think for strategic transactions where we see a founder kind of like teaming up with some potential investors or just by himself taking control of the whole company, I think banks are still supportive of such transactions. Here in Asia, perhaps it's a region where bank financing is a little bit different, and banks are a little bit more supportive and can finance some of these transactions. So yeah, I think for transactions like this, finance is still available, definitely.
Manuel, thank you so much. Manuel Baigorri there with the very latest on this great, wonderful scoop on L'Occitane. Now let's discuss this potential deal and what it says about the wider consumer and luxury market with Deborah Aitken from Bloomberg Intelligence. Deborah, you understand, you look at multiples and look at what this means, like day in, day out. You really are expert in terms of cosmetics and luxury and valuations. So L'Occitane stock is down some 20% in the last 12 months. What really plagued it?
I think, and also since IPO, I was looking back since 2010 IPO, it's only up 50% pre all the rumours in the market of a potential private move by the chair and CEO. So the idea is that it's available in over 3,000 stores, but it has 1,300 stores standalone. And that is expensive to run, 1,300. And I was just in with the makeup ladies, and I said, L'Occitane down on Cannon Street? No. So it just seems invisible in some areas. So it's about resonating with the younger consumer, doing more on social media, maybe getting some new life into the company. And also, for it as a standalone, it's 20% of sales in the US, 20% in China. We know China has had too much inventory into travel retail and others across many of its competitors like Estée and others. So there's a lot for it to do.
So Deborah, do you think it's because fashion changes? I remember when it was really cool and everyone was talking about it. It was like this French, brand from Provence and people liked it. Or is it because there's a problem with the segment that it's not really affordable, but it's also really high-end luxury? So it's kind of the squeezed middle.
It is the squeezed middle, but if you get your messaging right, it can do very, very well. We've seen some very high-end deals coming through. It can do very, very well. It's just that I think the messaging isn't hitting and resonating. The product is very good, organic, doing very, very well. It's just the messaging to me.
So do you think it'll relist in Europe? Will it get acquired?
I would imagine, both could be a possibility. It runs an 80% gross margin, but when you get to the op line, the op margin's only 11%. That compares against 18% at Estée, 20% at L'Oreal. So there's a lot to do in terms of transition. In terms of relisting, we also have Coty in the space seeking from US to also dual list within Europe.
And Coty's are perfumes, right?
Yeah, Coty's
cool
perfumes, more in skincare as well, makeup, but acquiring in premium skincare too. So that's a plan there. And then also we can think about others across the luxury space. Prada looking also to dual list into Europe. So potential there.
So there could be a bit of a trend. I have a million questions. It may be inappropriate, but is it a little bit like the Body Shop or L'Occitane, or you just really think it's a perception problem rather than an underlying bigger problem of where it is?
No, I think it's both. So because I think L'Oreal had the same thing. It was very much niche in its own area, did very, very well for years. Sold on the organic ahead of its time, moved into the L'Oreal business, moved out. We then saw it being acquired again. And I kind of think that there's therefore lots of avenues for L'Occitane in the way that it could go. Its product is very, very good. It's just that it's doing something wrong between the gross and the op line, and that needs to be adapted.
Deborah, in terms of the other story, which was quite exciting, I think like 10 days ago. So Kering, there are two big luxury companies, right? Kering and LVMH. LVMH is doing so much better than Kering. Kering's cash cow is Gucci, and they're struggling. And then they entered this deal with Valentino. Like, is this a trend? Or what does it tell us about the strength of the luxury sector?
The strength of luxury, the luxury sector overall, despite some of the negative headlines, I was looking at the half year, we're still seeing 12% growth at the half year, expecting double-digit growth for the full year for the luxury sector. So overall, the strength is there, the profitability is holding out, and there are more high-end users coming into the marketplace. The aspirational side is where the squeeze is, and if your product is not quite right or is seen as fashion-linked, there's been a little bit of softness there, and that's the issue with Gucci. For almost 2 years now, it's struggled versus its peer group. To give you a couple of numbers, we had 24% growth at the half one from Hermès, 17% from LVMH group across the board, and 2% from Kering. Within that, only 1% growth from Gucci. So it's doing a lot. It's reorganizing its board. A new board member coming in, ex-Chanel. CFO, and also the head of Yves Saint Laurent taking new dual CEO roles. And then also we have the creative director out, temporary, Palus taking over the CEO role at the moment of Gucci, and then they'll be looking to do lots more. And then also what's really interesting for the Gucci side under Kering, the new creative director coming in, who is in and where we'll see more of his product, De Santo, he was actually 13 years of Valentino. So what does that say when they're bringing the brands together?
It's a small world.
There's a lot going on.
Yeah, there's a lot going on.
Yes.
And then Kering also going after, the talent agency. We'll have to get you back on to talk about that, because I don't know whether this is world dominance from the luxury companies. Our Deborah Aitken there from Bloomberg Intelligence. Now, M&A bankers, thank you, Deborah. M&A bankers are set to see their bonuses tumble this year as the business remains stagnant. According to consultancy firm Johnson Associates, merger advisors could see payouts slump as much as 25%, and any respite is unlikely until next year. We'll hear with more as Bloomberg's finance managing editor. He's Tom Metcalf. Tom, always great. I mean, we get you on every day because there's something going on with the banks.
Always something going on.
They're either doing better or much worse than expected. I mean, what does this bonus actually tell us about the strength of this, of this part of the industry?
Yeah, I think there's no great surprises in the report. As you say, deal makers, their bonuses this year is not going to be great. I think also just kind of go through the structure, even fixed incomes. There might be a bit of disappointment there, though within that there'll be some real outperformers. I think if you're looking for the bright lights, it's actually the wealth side of things that they're saying, hey, this is going to do quite well this year. And I think the reason the bonus stories are interesting is what it says about the industry, and this really reinforces. If you're in M&A, you're having a rough time, but there are other sort of brighter spots in finance right now.
I mean, I love having you on talk about this because we always get bankers and saying, well, I don't feel too sorry for them because they made so much money in the last couple of years. How long will this continue? Are we seeing any green shoots? I mean, or is everyone going to work for a hedge fund?
Yeah, no, I think, on the deal-making side, there'll be a bit of a lag as well before the deals come through. So, look, it's clearly this whole year is basically a write-off. 2024, it just depends what happens. Do some big deals move through? And, of course, yes, everyone, looks towards the hedge funds as maybe the savior for the big paydays, but everyone's looking at that space. It's still a relatively small industry when you compare it to banking, so there's not that many other options out there.
And then there was a story saying they're all moving to Dubai, so we'll have to get you back on.
That's the other move. Move to Dubai.
Hedge fund. There you go. Become a hedge fund and move to Dubai. You did not hear this on the Pulse. Thank you so much, Tom, for joining us. Bloomberg's managing editor for finance, Tom Metcalf. Coming up, can Europe's second most valuable company continue its momentum? Today's big take is on the pharma giant, Novo Nordisk. That's next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
Another crazy busy week.
There's still a lot of uncertainty.
The market knows that there's bad things coming.
Bloomberg breaks the numbers first.
A slew of earnings.
Some breaking earnings.
What did we learn from earnings? I mean, a lot of them beat. Some of them got slammed.
With exclusive expert analysis.
This is a growth story.
Advertisers are pulling back. It certainly will be a headwind.
Good revenue growth across the globe. A record year.
We haven't seen a result like that since a decade.
We're not standing still.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in London. Now, it was talked about at the Oscars. Elon Musk is said to love it, and there's even a song dedicated to it. The weight loss drugs Ozempic and Wegovy have propelled Novo Nordisk to become Europe's second most valuable company. Now, after a record gain yesterday, trading of Novo Nordisk this morning is seeing some pressure. The firm's struggle to meet demand are also raising questions. So can it hold onto the momentum and live up to the hype? Well, those are the questions we're exploring on today's Big Take. Let's go straight to Naomi Kresge, who covers European pharmaceuticals for us. So, Naomi, I mean, this is a huge story. If you look at how much it gained in market share yesterday, it's our big number of today, it's some 68 billion. What's Novo Nordisk's challenge now that the SELECT trial has come back so positive?
Yeah, I mean, I think at this point, the challenge really becomes one of execution, right? Yesterday's trial results were a home run, really. And now the question is, how do they move forward from that and make sure that they can produce enough of these medicines to meet the demand that almost certainly will increase after the trial results.
So what's unique, Naomi, about this company?
So in so many ways, it's just so Danish. It has a foundation as an anchor shareholder. There's just a tremendous amount of stability because of this. Also, when it comes to corporate culture, there's a culture of being able to have work-life balance, flex time. A lot of employees just taking July off in Copenhagen at the headquarters. And so this I think is really, really quite unique.
So are there potential downside risks right now? What are investors expecting from Novo?
I think it does really become a story about whether they will be able to meet demand for these medicines, whether they will be able to really capitalize on the first mover advantage. They're the only ones right now that have a weight loss shot with this level of proven effectiveness, this heart benefit that's now been shown. And they are really in a space of needing to roll it out in more countries and make sure that they can meet the demand that does exist.
Naomi, thank you so much. Bloomberg's Naomi Kresge there with the very latest on Novo Nordisk, and you can read today's Big Take in full. Just check out NI Big Take Go on your Bloomberg terminal. Now, we'll also be speaking to the Novo Nordisk Chief Executive Officer tomorrow. I'm excited about that interview, Lars Fruergaard, and that's tomorrow at 9 a.m. UK time, right here on Bloomberg. We also look at WeWork shares. They've continued to plunge in pre-market trade. This is after the company said there's, quote, substantial doubt about its ability to continue operating. Now, the co-working business cited sustained losses and canceled memberships to its office spaces. WeWork says it will spend the next 12 months reducing rental costs, negotiating more favorable leases, and increasing revenue. Also, Wells Fargo and BNP Paribas are among firms that will pay hundreds of millions of dollars in penalties for employees using WhatsApp and other unofficial tools to conduct business. It's the latest crackdown by U.S. regulators on Wall Street's failure to keep records of communication. Now, total fines over messaging violations have now topped $2.5 billion. Coming up, SoftBank Group's arm is said to be in talks with some U.S. big tech as investors expect an IPO next month. So we'll bring you more on that Bloomberg scoop next. And this is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The insights you need. This is a pulse, and I'm Francine Lacqua here in London. Now, the Fed says it's stepping up scrutiny of lenders' involvement in digital assets, the latest move by the U.S. regulators to limit banks' involvement in crypto. The U.S. Central Bank says they will focus on banks' partnerships with firms that are not lenders, such as fintech companies, to provide services to customers. Now, over the past year, the central bank and other regulators have repeatedly warned lenders to be wary of risks associated with the asset class. Also, Galaxy Digital founder and chief executive officer Mike Novogratz has commented on the U.S. approach to regulating crypto assets.
The approach from the SEC to regulate through enforcement and to really thwart our industry, which feels like it's come from Elizabeth Warren and Sherrod Brown and maybe Lael Brainerd and a few people, we called it Choke Point 2.0 operation. seems obvious and is just un-American.
Well, Amazon is said to be in talks about joining other tech companies and as an anchor investor in the IPO of chip designer ARM. The listing of the UK-based firm is expected to raise as much as $10 billion. Now, a source says Amazon is one of about 10 tech companies in talks with Intel, Alphabet, and NVIDIA, also amongst potential investors. Now, the SoftBank-backed company could list as soon as early next month. So let's go straight to Bloomberg's Mark Bergen, who covers EMEA startups and VCs for us. Mark, I mean, this is an amazing story, right? First of all, why would Amazon want to invest in ARM?
It's probably a little bit of FOMO, the fear of missing out here. This is set to be the biggest tech IPO since Alibaba and Facebook, now Meta. You know, Amazon has also made a big strategic investment with ARM so far as just a commercial relationship. ARM is, they chose ARM as sort of the chip designer for their data centers, which was an unusual choice and one that's probably paid off pretty well. AWS is like leading that market. I think there's roughly 40,000 we reported AWS customers that are already using ARM technology. ARM is trying to move, right now its technology is primarily used in smartphones, tablets, computers. It's trying to move up to data centers. It seems like that's a strategic partnership here where AWS is saying that we're going to get in on this technology, not just a commercial relationship, but as an investor. And for ARM, it's clearly a critical and important customer.
So, Mark, how does this fit into ARM's business strategy?
Yeah, so I think that's my understanding is that this is really critical for them. ARM and SoftBank, the owner, are making this big bet that this wave we've had in generative AI and artificial intelligence is just going to continue, going to keep going up. The big demand for artificial intelligence is on computing power, mostly from the tools that NVIDIA sells, and data centers. Like, it needs a lot of computing resources here. So if ARM can, in fact, kind of pivot to becoming an integral part of data centers, that is a big market opportunity for them.
So, Mark, is this why all the big tech, I mean, 10 big tech companies is a lot. Is that why they're all so interested in this IPO?
Yeah, I think so. We've reported that NVIDIA and Intel are also in. You know, the chip market is really hot right now after kind of being cool for such a long time. This is ARM is this sort of critical part of it's like the blueprint for this technology. You know, SoftBank had previously tried to combine and merge this with NVIDIA, which didn't work. This is the big take. I think there's also, you know, there's a lot of hope and optimism that it both revitalizes some of the IPO market, which is in tech has certainly been very cold, and then proves that this AI hype here is here to last.
Okay, brilliant reporting, Mark. Thank you so much, Mark Bergen, there, looking at this potential IPO of ARM. Now, the other story that we talked about yesterday and again today is Italian banks. So the Italian government seems to have backtracked on part of its new windfall tax on banks, saying it would introduce a cap to limit the impact for many lenders as it tries to calm a market rout that wiped out some $10 billion from the bank's market value. Now, the levy, we understand, will not exceed 0.1% of the firm's assets, and banks that have already increased the interest rate offered to depositors will not have a significant impact as a consequence of the rule. So yesterday they were down some 8-9%. Today you can see Intesa Sanpaolo gaining some 3.2%, Unicredit gaining 4.3%. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, our Danny Berger here in London, and this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China slides into deflation. The country's consumer and producer prices decline together for the first time since 2020. So far, so good for this week's historic Treasury debt auction. 30-year notes get a bid. Up next, we get 10 and 30-year debt sales over the next 2 days. And as SoftBank's arm gears up for what promises to be the biggest tech IPO of the year, Amazon joins the party as a key investor. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, a bit of a breather from that bank sell-off. Bonds, though, still getting a bid today.
Yeah, well, risk sentiment is turning on its head, though. And if you look at that in the equity market, it really comes out as green on the screen here. Futures higher by about 0.4%, 45.34 on those contracts for our radio audience. But Danny, to your point, it is the bond market that's getting a bid. But you really have to go way out into the curve to see any real sort of conviction. The 30-year yield at about 4.20 or 4.19 is what we'll call it, down about 2 basis points. Because if you look on the front end, the 2-year or even the 10-year, for example, kind of in that mid-range, it's not doing a whole lot this morning. So really interesting to keep that in mind, given, again, the questions of digesting some of that supply that we are going to get today and tomorrow, Danny. We're going to dive into that in just a little moment. Oh, we're going to talk about the Asia index, though, because, of course, we are seeing a lot of movement in China. A lot of that's going to be driving the trade this morning. And I think it's important to keep in mind that you are actually seeing the yuan strengthen overnight. That is a big deal, given it has kind of snapped a 3-day move from after the fixing. So dollar yuan now at about 7.22 is what we'll call it. The dollar weaker by about 0.3%. Of course, a lot of that's going to have a read-through into the commodity index. Of course, as you have a weaker dollar, commodities broadly are going to be higher. Gold, copper, oil, you name it. In addition to the fact that you are going to see China perhaps doing a little bit well. There is some cross-asset movement there. But Danny, speaking of cross-asset movement, let me bring you a redhead that just crossed the Bloomberg terminal. Rice in Asia. Remember, rice is the largest used commodity around the world in terms of food, in terms of soft commodities. Well, it's soaring to to the highest level since 2008 on the supply risk. This is a really big deal. We know that protectionism has been a really big part of the global conversation, especially when it comes to India, one of the major exporters, and just the fact that a lot of the developing world is very dependent on that. So you are starting to see, because of those supply risks, the price hit a real record.
Yeah, it's a global story. There are risks everywhere with agricultural commodities, not just weather. You have war, issues like that. Here in the UK, we certainly are facing food inflation that this week. The BOE's chief economist, Hugh Pill, said that it's not going away anytime soon. Okay, it is a relief rally here in Europe about banks. Italian banks and the entirety of the banking sector is coming back. European banks fell over 3% yesterday. We're up nearly 2%, so we haven't made up all of those losses. But Italy, late yesterday, perhaps sensing this turmoil in the market, issued a clarification on their windfall tax. They say, hey, banks, it won't exceed 0.1% of your profits. And if you've already increased the deposit rate that those coming to your bank are getting, then we won't affect you as much. This won't affect your bottom line as much. I didn't really give too much clarification on that, but again, trying to calm things. So not just the overall bank index, but Italian banks to the FTSE MIB, that's up 2%. Meanwhile, the bond story is the same here, Critty. We've seen this huge rally in duration in Germany across European sovereign debt. I just brought up the 10-year yield in Germany to show that it's not moving. That finally, it's a day without volatility. Just want to flag in about 30 minutes time, it's not just the U.S. that gets auctions. A German 10-year auction will be going through. If there's any significant moment, Critty, we'll bring that to our viewers.
Yeah, a lot to digest here. It's going to be really interesting. I feel like we haven't talked a lot about the Asia read-through in maybe a couple of days here, Danny, but I think we're going to snap that today when it comes to today's trading session, at least here in the States, because we did get some economic data. China's consumer and producer prices both declining in July from a year ago, to sign that deflationary pressure, well, it's likely to be temporary as policymakers face calls to step up monetary and fiscal support.
China is in deflation for sure. The question is how long?
The market lacks some short-term confidence. And that is probably because we've had a lot of supply-side policies. But until we solve the demand-side issue, there's still going to be a bit of a gap.
Investors are really clamoring for broad-based stimulus. I don't think that we're going to get that.
There's no reason not to be optimistic about the future and the long-term prospects of China.
Jill Deese is Bloomberg's China economy and government editor, joins us now. Jill, what's so fascinating about the China story specifically is that if you are indeed worried about exporting deflation, that could actually be welcomed by a lot of the central bank governors around the world. Walk us through what this data actually means.
Hey, Critty, yeah, that's right. I think that at this point, really, it's everybody's looking at that CPI gauge, right? Because factory gate prices, of course, as we know, have been in deflation for, I think, about 10 months now. A lot of that has to do with softer commodity prices. But when you look at that CPI gauge, remember, I mean, the last time we actually saw consumer prices in deflation in China was late 2020, early 2021. That's right in the middle of the pandemic. Now, though, I mean, this was supposed to be, 2023, the year when China was emerging from the pandemic. The economic recovery was supposed to pick up, and a lot of that was supposed to be consumption driven. I think what you're seeing feed through in those weaker CPI prices is, that lack of confidence, particularly among households, trying to get people to spend. Yes, I think that, from a global perspective, there is maybe some read through where central banks in places like the US and Europe might actually, this might come as a bit of a relief for them if they're looking to, look for any sort of help from elsewhere in the world on how to tame higher inflation, particularly in the US and Europe, although I would caution that's a bit limited considering how much the US and Europe have worked to ring fence some of their operations from, a certain exposure to China. But yeah, I think what you just heard that in the collection of clips there from a bunch of experts, though, is what we're waiting to see is how much this pushes policymakers within China to maybe introduce some additional policies to help boost demand within China. I do think that's going to be somewhat limited, but we'll have to see what that looks like in the coming weeks.
And perhaps we already knew that this was coming, hence not the biggest of market reactions. Jill, speaking of pulling back on investments, you mentioned this. The Bloomberg team does have a scoop on the U.S. limits to China investments, obviously chips in mind here, but it's not going to be as extensive as we originally thought. What do we know about what the U.S. will do, what they will enact?
That's right, Danny. So look, I think what we're hearing right now about these potential investment curbs is it's a lot less ambitious than maybe what was originally proposed. The idea being that the U.S. wants to limit American investments in certain sectors in China, particularly quantum computing, artificial intelligence. But this proposal would limit that to companies where they have more than half of their revenue coming from those particular fields. So that, in theory, would make it okay if you're an American investor to invest in a Chinese conglomerate where they do some work there, but it's not more than half of their revenue, right? And I think the other thing, too, with some of these proposals is that it could be that it's not retroactive. So maybe once the plan is in place, if you were investing in something prior to then, it's actually okay. What I think this, I mean, look, on the heels of the Janet Yellen visit to China just recently, you know, she made a point of saying that they wanted to target curbs on China. They want to continue working with this relationship. We know how important the relationship between the world's two largest economies is. But yeah, I do think this is a bit of a softening in the U.S. stance, at least in terms of what is proposed in the investment curves here.
Yeah, a lot to digest out of China. Joe, we're going to throw one more at you. The country garden default, now Bloomberg Intelligence saying that it could be worse than what we're hearing out of Evergrande. Walk us through just the significance of this story.
Sure, Critty. Well, I just explained to you a few minutes ago, you know, about all these concerns with the economic recovery in China, lack of household confidence. Why is that? In large part, it's because of this ongoing property crisis that we've been dealing with for years at this point. I think that what you're seeing in the country garden, you know, issues right now is you know, sort of more symptomatic of those issues, right? I mean, this is the 6th largest developer in China by sales. I think any concerns that they're missing payments, that, you know, if that creates liquidity concerns, if that creates concerns about failure, this is a developer that has a lot of big projects in China. I think that that's just, you know, continues to feed those concerns that the property market crisis in China isn't going away anytime soon.
Yeah, a massive company, bigger than Evergrande, and probably a name that, you know, a lot of our international audience outside of China might not have heard of. So, Jill, thanks for keeping us on top of it. Jill Desis there with the latest. Now, it also might be a reason we saw bonds rally in the Asia trade yesterday. Now, speaking of that, we did have Tuesday's $42 billion sale of 3-year Treasury notes, and did show signs of stronger than expected demand, had record stacks, and it is a week of auction deluge. Next is $38 billion worth of 10-year notes on sale. For more on this, let's bring in Bloomberg's Valerie Teitel. Valerie, what will a strong or weak auction tell us?
Look, we're very sensitive now to the demand for treasuries, now that we know that the U.S. Treasury is just increasing its issuance for these bonds for the next quarter, and we're likely going to see more issuance to come in the 4th quarter and next year because of this growing deficit. So a lot of attention on just what is the underlying demand for treasuries. We know foreign demand has been stepping back a bit, and we're looking for evidence in these auctions of just any weakness. Now, we didn't get that yesterday. The 3-year auction was quite stellar, but it's really going to be the 10-year and the 30-year that are going to be the better test. That steepening pressure we saw last week, that the yields moved higher, led by the long end, and that big questions over who are the buyers of this incremental size that the Treasury wants to issue when it comes to that long end paper specifically.
Well, speaking of that long end paper, I mean, it feels like we would have already seen some sort of signs of not being able to digest the supply being issued. We already had kind of warnings from that from some of the folks on Wall Street as well. But Valerie, we're not seeing that yet. Is there a chance that this all just kind of goes fine?
Well, it could be a chance, Critty, that this is just more of a very slow-burning market topic. We know this is going to be an issue that is going to really be pivotal for markets maybe in the next 5 to 10 years. If you look at the Congressional Budget Office, their estimation for the Treasury market in 10 years' time is to double in size. That's definitely going to have some macro implications somewhere. It's just a matter of fact of when maybe the market begins to price that in, or perhaps this is just a very long, slow, growing macro trade.
Valerie, thank you very much. That's Bloomberg's Valerie Teitel. Now, in corporate news, Amazon is said to be in talks joining another tech company, other tech companies that is, there's more than one, as an anchor investor in the IPO of chip designer ARM. Now, the listing of the UK-based firm is expected to raise as much as $10 billion. Joining us now is Bloomberg's Tom McKenzie. Tom, first of all, a big IPO, which is exciting since we've gotten basically nothing. But what's in this for Amazon? Why would Amazon join on?
Well, for Amazon, they have AWS, of course, a core profit center for that business. And Amazon Web Services, well, their preferred chip is a chip designed by ARM. So that's the skin in the game for Amazon. They have 40,000 AWS customers. So obviously they want to see ARM do well, and that's why they're in discussion to take this anchor role. By the way, it's worth noting that Intel, NVIDIA, and a number of other tech companies and other customers to ARM are also considering taking these anchor roles as well. So it looks like it's lining up to be positive ahead of this IPO, as you said, in September. In terms of the time frame, the roadshow is expected to start in the first week of next month, then the pricing the following week. In terms of what ARM gets out of this, the CEO of that company has made it very clear they want to get more growth in the data center part of the business. So that's the opportunity for them in terms of that partnership and that linkage with Amazon.
Well, Tom, it's so interesting to me that you're already seeing kind of signs of that vertical integration, to your point that a lot of these people are looking for that company investment. Let's go to another corporate story here, which is kind of related, has a lot to do with SoftBank, of course, the parent company. WeWork plummeting in the pre-market, the co-working company raising serious concern to go out of business. Is there a way back for WeWork, or is this story kind of done here?
Well, look, the company itself says that there is significant doubt that it will be able to remain in business. They are bleeding cash. They've had to, of course, cut headcount. We know that. They're looking to raise capital, they say. They want to renegotiate some of these leases, but they've seen membership numbers plummet. It is a very challenging time. The CEO who took over, of course, from Adam Newman, who ditched or left the company, was pushed out, of course, after that disastrous planned IPO. The CEO actually stepped down in May. They've had 3 changes at the top of the board. They have a 12-month plan now to try to resize and reset this business. But again, quoting from WeWork, they say that there is now significant doubt that this business can actually remain afloat. So it's going to be deeply challenging in the months ahead for this business.
Yeah, saying you have substantial doubt whether you can keep operating, not something that exactly inspires hope. Tom, thank you very much. Tom McKenzie there. All right, coming up, we're going to get back to that Italian bank story. Italy has issued a new clarification of its new tax on windfall profits for banks. We're going to have more on that shortly. And we'll be catching up with Skylar Montgomery-Koning, Senior Global Macro Strategist at TS Lombard, trying to discern these summer markets later this hour. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Italy has issued a clarification on its surprise bank profit windfall tax after lenders had some $10 billion wiped off of their value. For the latest, let's get to Bloomberg's Alessandra Migliaccio in Rome. Alessandra, walk us through what's actually been said. How much does it really change given the markets have already kind of had their freak out about it?
Yeah. They've definitely had their freak out about it. I mean, it was a surprise announcement, not expected in any way. We had drafts of, what the government was going to pass. 40% tax on banks clearly created a huge market rout, wiped out 10 billion, as you said. But, all of yesterday, the finance ministry, which is actually responsible for the norm, has been walking it back. They've been fixing it. So I think what the takeaway is, we don't even know at this point how much will have to be paid by the banks, if anything, because on the one hand, you have the finance ministry, getting into the technicalities and explaining that the levy won't exceed 0.1% of a firm's assets. Banks that have already increased the interest rates offered to people, to depositors, may not even have to pay much, et cetera, et cetera. And also, we have some evidence that in the past, because this is a retroactive norm, when companies have gone to the courts, they've won. So it's more a populist move by Deputy Premier Matteo Salvini, to make his electorate happy. They're very unhappy about banks not really passing on the interest rate increases to, people who have their accounts in banks. Banks are getting rich is sort of the thing that's getting out there, and they're not giving money to clients. And so Salvini is doing that for his base. Whether it actually affects banks in the end, it's not certain.
Okay. Alessandra, thank you very much for that update. Alessandra Migliaccio in Rome. Now, turning here to the UK, it's headed for 5 years of lost economic growth as the government fails in its goal to level up. That's according to the National Institute of Economic and Social Research. Joining us now is UK economy editor Reid Landberg. Reid, a pretty grim report. Look, I mean, we're not necessarily the most optimistic on the UK economy already, but what was your takeaway from some of what we learned in there?
Well, the really big picture is we've got sputtering and stagnant growth. It's a little bit of growth. It's not a recession. The worst does not come to pass. But equally, we're not seeing really good growth out there. And, NISA has identified a number of headwinds to the economy. We knew about the labor market. The labor market, 500,000 people dropped out of the workforce during the pandemic, and a lot of them haven't come back. But one of the other things they're identifying is that the Treasury is actually borrowing more, and that's a constraint on growth as well.
What does that have in terms of the read-through for the markets here? Because, look, this has been something that has been discussed at the likes of the IMF and even the World Bank for, I want to say, at least 1 to 2 years now. But in terms of the markets, we're not necessarily seeing, I think, the sell-off that a lot of people expected in the long term. When do we see that?
No, what's interesting is it's sort of tempering market expectations for where interest rates go from here. Just a month and a half ago, we were looking at interest rates topping over 6%. That would have been the highest in, this century, easily. Now, the market is looking at just a half-point increase more from here by February, and that might not even happen. So we're also seeing that weaken the pound a little bit as well.
Yeah, I forgot about that time, especially when we had what it was like almost 6.5 at one point priced into rates. So at least we've calmed down from there. But yeah, maybe not for a good reason if we're worried about this economy. Reid, thank you so much for joining. Really appreciate your time this morning. That's the Bloomberg UK economy editor, Reid Landberg. Now, coming up, some corporate news for you. Skincare brand L'Occitane said to be in talks on a potential deal to take the company private. That Bloomberg scoop is up next. This is Bloomberg.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there to kind of upside.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now to a Bloomberg scoop. L'Occitane's controlling shareholder is said to be in advanced talks on a potential deal to take the skincare company private at a valuation of about $6.5 billion. Financing for the proposed bid has been lined up, and a deal could be announced in the coming days. Unfortunately, they were going to list it on in Europe. That was one of the options, so that's not happening. But it is more deal news because it's been tough for the deal makers. Now, speaking of them, bonuses for merger advisors are likely to tumble as much as 25% this year, though asset management executives will see a modest gain. Kriti, that's according to a report from Johnson Associates. So if you're planning on getting reincarnated as a banker, make sure that you're going to be in the asset management side and not the M&A side.
Well, Danny, I'm sure people have told you this. They tell me this all the time, is that you're still young. You have plenty of things to do. So maybe you and I can still take full advantage of that. But I think it's really interesting. It speaks to the idea that, look, maybe the kind of crisis that we are seeing in banking when it comes to even layoffs or kind of deal flow, that maybe there might be some sort of turnaround in line, by the way, with the turnaround you're kind of seeing in the economic data as well. Maybe this isn't as big of a kind of glut as or rut or whatever phrase you want to use as I think a lot of people were thinking it might be.
Well, this is the thing. I mean, I talk to private equity folks a lot, and we've talked to them on this show, Kriti. The refrain I keep hearing over and over again, whether it's on the show with us or private, is that post-summer is when deal activity is going to pick up. I keep hearing this over and over, but I'm not certain what would get us there, what would allow deal activity to pick up. Kriti, perhaps the only thing is that if interest rates are held steady, we can kind of adapt to this new normal. But there's always that threat that inflation really reaccelerates and the Fed will have to keep hiking even after the summer.
Yeah, I'll also add that maybe a new president might also change that as well. You do have, of course, have that antitrust risk as well that I think has chilled a lot of the deal flow, not just here, but around the world, and that could flip it on its head.
Yeah, definitely. I thought you were going to get into politics, a presidential election. I mean, that could also shake things up, too. All right, coming up, we're going to get to the macro story with Skylar Montgomery Koning of TS Lombard. This is Bloomberg.
City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate while this is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China slides into deflation. The country's consumer and producer prices declining together for the first time since 2020. And it's so far so good for this week's historic Treasury debt auction. 3-year notes getting a bid. And up next, we're getting the 10 and 30-year debt sales over the next 2 days. Meanwhile, SoftBank's ARM gears up for what promises to be the biggest tech IPO of the year. Amazon joins the party as a key investor. I'm Kriti Gupta in New York with Danny Berger in London. Danny, so much news to digest, so many cross currents, but it almost feels like the trade today is just a reversal of what it was yesterday.
Yeah, and it's a reversal in Europe, thanks in part to what Italy has done. It seems that this bank sell-off, sparked by Italy saying that they would impose a tax on windfall profits. The fact that the market was spooked by that, we did have officials coming out and say, wait, it's not going to be that bad. Just 0.1% of your assets is the max you will get on those taxes. And if you're already upping deposits, what investors are getting if they're putting their money with you, then we'll leave you alone, at least to some extent. So that's allowing a rally both in European banking stocks and the FTSE MIB as a whole. Both are up just under 2%. And just want to point out in Germany, the bond rally we've seen has taken a breather. We're basically unchanged, not even 1 basis point move on the bund on the 10-year yield at this moment. So besides the Italian banking story, Kriti, not any really huge moves in Europe, a day perhaps of assessing of these edgy summer markets.
Yeah, and I think a lot of that sentiment perhaps feeding into the U.S. as well, specifically when you look at futures here. Green on the screen, Danny, higher by about 0.3%, 45.32 on those contracts for our radio audience. Look, the bond market gets interesting, though, because, Danny, to your point, you're seeing a little bit of a bid into the bond market, but you have to really go out into the curve to really see it this early in the morning. We're looking at a 30-year yield, at about 4.19, down about 2 basis points this morning. If we go to the front end of the curve or even further to the 10, you're not seeing that much action. So I wonder how much of this really is at the whim of those Treasury auctions that we're going to get. Again, we're going to digest that in just a few moments. Look at dollar yuan, though. I think that's a really important story. We are starting to see the Chinese economy, to your point, weaken just a little bit. And as we do, there is going to be more and more attempts for the PBOC to kind of step in. Today is the first day you are seeing that 3-day snap reverse, and that for the yuan, the dollar weaker against the offshore yuan, 722 we'll call it, weaker by about 0.3%. And I think that weakness feeding a little bit into the commodity story. The Bloomberg Commodity Index stronger broadly across the board, higher by 0.5%. But we should also mention rice in Asia, the highest level since 2008. This is a really big deal given that there is this element of protectionism, specifically coming out of India, which of course feeds not only the Indian population, the Indian diaspora, but a lot of Southeast Asia and simply the developing world, which relies more on the likes of rice than things like wheat or grain, for example, Danny. So this is definitely a story we're going to be wanting to watch when it comes to the way the international food security story plays out.
Honestly, if you want rice, come over to the Burger household. We literally have like hordes of rice, huge tubs. My husband always keeps some, which I never understand, but now perhaps it finally makes sense. Maybe we're the problem. Maybe we're adding to inflation. Okay, Gritty, a different topic. On a serious note, I want to bring a chart that got a lot of buzz yesterday. The New York Fed came out with a survey on consumer credit card debt in America. This number has topped $1 trillion for the first time. So this chart that we're looking at here, it ends at the end of May, so it's a little bit backwards looking. But still, you can see this really big run up here. This is the pandemic, and it just shows to what degree consumer spending is starting to increasingly be fueled by credit card spending. Now, the New York Fed did say at the same time that delinquencies were starting to stabilize and the consumer does look strong. But is that in danger of spending as a consumer continues to rack up debt? Let's talk about this and more with Skylar Montgomery-Koning, who joins us now, Senior Global Macro Strategist at TS Lombard. Skylar, when you look at data like this and some of the other consumer indicators that we're seeing, do you see a consumer that's staying strong, that's still happy to spend, or do you see a consumer that's in danger of running out of steam?
Yeah, I think, credit card debt being at such high levels, it's just another avenue that squeezes the tightening cycle progresses. And it feeds into the slowing of the economy, right? So we're getting these little squeezes everywhere that eventually will add up to being quite a big squeeze. But as you've had this ballooning of credit card debt, there is a limit on how maintainable it is, right? There's a certain point where the cost of maintaining that debt makes it very hard to get out of it, where interest payments are very high, especially as COVID savings are depleted. And if consumers are spending an increasing share of their income on interest payments, that's consumption that isn't occurring in other parts of the economy, and it isn't feeding into GDP. At the same time, there's an effect through the banking sector. So the latest reporting season, we've seen banks report very large losses on loans. And loan loss provisions, that's not a news story. The trend has been rising loan loss provisions for 3 or 4 quarters now. But what we're seeing now is large losses, and more than half of those losses are from credit card loans. And this environment means that banks continue to tighten credit conditions, which in turn makes it harder for consumers to keep up with that debt. And that, again, slows the economy.
Skylar, when we were talking a lot about kind of real wages being under pressure, the concept of the wealth effect was really entering kind of the market conversation on Wall Street. What happened to the wealth effect, especially when you are still seeing a lot of real wages under pressure relatively to the last couple of years? You are seeing these union conversations. When it comes to things like credit card spend, which you just laid out, where does the wealth effect play a role?
Yeah, it's really interesting because we had this massive fiscal stimulus that happened during COVID, and we had these very high levels of savings, and that held the consumer strong for quite a while. But you're seeing that the declines you saw in equity prices and fixed income prices, just kind of the pretty ghastly market that we had last year, that's fed into the data in terms of the fiscal deficit, for example. Capital gains taxes, that was a significant decrease in the fiscal deficit in terms of it meant that receipts were much lower. And so there is some kind of impact that's feeding through in the same way that you're having kind of automatic stabilizers feed in terms of, higher cost of living increases has meant that people, that there's been more money spent on these kind of social programs as well. And so these kind of marginal things are having an effect. It's just kind of at the edges, and it'll continue to squeeze and it'll continue to have an impact. But the problem is that we're coming from such high levels and you're seeing a decline. So the question is just, when do we get to a point where it really squeezes the economy? We're now getting to the point where inflation is higher than wage inflation is higher than CPI. And so that means real wages are rising now, and that will continue to squeeze, and it'll also have an impact through margins.
Yeah. A very fair point, and it's interesting because there is always that lag in terms of actually seeing the real wages increase in the data and then someone actually feeling it in their paycheck. Skylar, I want to ask you about simply the stimulative measures that I think a lot of people are criticizing the White House for. For example, we are talking about squeezing, we are talking about the balance sheet from the Federal Reserve coming down, but at the same time, there are programs like loan forgiveness, for example, which again was very scrutinized by the folks who really need the Federal Reserve to tighten even faster. Walk us through that. How much of that is a problem for what the Fed is trying to do here?
Yeah, it's quite interesting because we've had this kind of stealth deficit deterioration in the US. So if you look on the face of it, the deficit looks pretty stable in terms of the CBO numbers for this year versus last year on the face of it are pretty much unchanged. But that's because of student loan forgiveness. So the program added $430 billion to the 2022 budget. And when the Supreme Court prevented the debt forgiveness, this sum was in part deducted from the 2023 deficit estimate. So without student loan forgiveness, your deficit for 2022 is under $1 trillion, and your deficit for 2023 is $1.8 trillion. Now, that's a substantial increase, and it's very unusual when there isn't a large fiscal package or there's not a recession. And in a weird way, as I say, even though the economy is strong, it's because of these automatic stabilizers, right? So poor market performance has meant capital gain taxes are down. On the spending side, the cost of living increases have meant increased spending on fiscal social programs, and rising interest rates have meant an increased cost of debt. So that increased deficit requires increased debt issuance. And so, you know, in part, maybe that increased debt issuance helps what the Fed's trying to achieve in terms of it means higher yields and higher real yields with this upward pressure on yield that will likely be maintained. But it has meant that we've seen a very strong consumer, and there's been more resilience to tightening policy than was initially expected.
Skylar, a little bit of a different topic, but it does feel that here in Europe and in the US, we've been able to kind of slightly ignore the property crisis taking hold in China. At least it feels like it's kind of been simmering in the background for a little bit at this point. But the fact that Country Garden, which has 4 times as many projects as Evergrande, was China's biggest developer by sales in the last 5 years. So a massive, massive property developer. The fact that they are under pressure to repay some of their coupon that was due on Monday, that they might default, has kind of reignited this. What are the odds that we might see the Fed hiking cycle come to an end because of a property crisis in China?
Yeah, it's interesting because it's kind of a parallel that's been drawn before, right? I think, you know, what I will say is that the Fed is at the end of the tightening cycle. That's very clear. It's very clear that they want to wait and see how the lagged and cumulative impact of what they've done feeds into the economy. I think they're very comfortable where inflation is and the trajectory of inflation. I think what tells you that is that the SVB crisis, when that happened, they were very quick to pause. And so that tells me that if you do have an issue that you're worried about coming to U.S. shores, you're worried about impacting the U.S. economy, you know, it wouldn't be that hard to get cuts from the Fed. And, you know, they're angling towards Fed cuts in 2024, even if they get a soft landing. So you'd imagine if something goes wrong, it's not that hard to get deep cuts now. If you look at the past 10 cutting cycles, the Fed has cut when CPI is averaged at 5.8%. You know, we're lower than that in headline terms. Core is around that level, but I think it tells you that they're comfortable. The question is just, you know, how much contagion are you really getting from China in terms of we've had these rounds of disappointment and property has continued to be an issue for China that they're kind of slowly dealing with. And so I think there's less of a risk of that contagion really coming to the U.S.
Yeah, really hard to kind of make those historical parallels, Skylar. It's going to be interesting to see how in 10 years we go back and look at how this is all paying out. Skylar Montgomery Koning, we thank you as always for joining the program. Coming up on the show, we go micro. Disney reporting its quarterly results after the U.S. market closed. From streaming profitability to Bob Iger's restructuring plan, even the labor story. We're going to dig into all of it. Stick with us. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history.
Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Disney reports its latest results after the U.S. closed today. Investors looking for commentary on progress the company is making towards reaching profitability in its streaming business next year. For more on what to expect, we're joined now by Geetha Ranganathan, Bloomberg Intelligence's star media analyst, I might add. Geetha, thank you for waking up early and joining us this morning. Let's start there. The profitability plan for Disney. The last we heard, I think, from Bob Iger himself was that there are potential plans to spin out the likes of ABC, for example, and really hone in on those cost-cutting measures. What might that look like?
Yeah, definitely Bob Iger juggling a lot of different balls in the air, Kriti. So this is going to be a really pivotal report because if you've kind of just looked at Disney stock over the past few months, sentiment has really deteriorated. And there are a lot of pending questions, as you just kind of alluded to. So yes, he has said that the TV network business, which constitutes the Disney Channel, the ABC broadcast stations, the ABC network, a lot of channels that they acquired from Fox, they are no longer core to Disney. They are non-core assets, and he does not mind spinning them out. So it's going to be interesting to see if they've made any progress on that front. Having said that, though, I mean, these are businesses that still throw out a lot of cash. So, yes, they are in secular decline. Yes, cord cutting is a thing, and it is getting really, really, dangerously high. But still, the business does generate, ex-ESPN, the business does generate $3.5 to $4 billion in EBITDA every year. So, they're going to have to see what plan they can come up with, and it'll be interesting to see what Bob Iger has to say today.
Does the ESPN and their contract with Penn that we learned about yesterday, Geetha, fit in all of this? Of course, Penn, the casino company, signing a deal with Disney's ESPN to use some of their licensing, maybe helping ESPN get into the online gambling business. Well, where does that fit into this overall structure?
Yeah, I mean, I think it actually fits in just perfectly. So it provides them with much needed cash, so about $2 billion over a period of 10 years, $1.5 billion of which is in cash. And what it does is it's kind of this really low risk move for ESPN because they're not directly getting into the online sports betting business. I mean, Bob Iger really never wanted to do that. I mean, ESPN does have, or Disney does kind of have this family friendly image. So I'm not really sure he wanted to directly get involved with regulation, with all of that stuff. So this is kind of a really neat, clean way for ESPN to kind of reap the benefits of online sports betting without necessarily getting into all the the nitpicky, dirty details. So I think it's a really good move for ESPN.
Geetha, I had the most fascinating conversation yesterday with someone in the creative industry who was talking about the length of some of the labor strikes and basically the hit that a lot of these streaming companies might be able to withstand, but also ultimately take. To me, when I ultimately heard about the likes of the writer's strike, for example, the time frame that was given was that the record number was about 100 days back in 2007. Now it feels like into the conversation, people are forecasting this could last upwards of a year. In terms of timing, Geetha, talk to us about the read-through into the bottom line for the likes of Disney.
Yeah, this is a really tricky situation, not just for Disney, Kriti and Danny, but actually across the industry. I mean, content at the end of the day is the lifeblood of all of these media companies, and you need new content. You need fresh content to kind of keep viewers engaged and keep them coming back to your platform. So yes, ironically, the strike has actually been kind of this blessing in disguise for the bottom lines of these companies, because there's been so much of focus on profitability, on free cash flow. We saw Warner Brothers Discovery actually post a little bump in their free cash flow. We saw Paramount, which just reported, also say that their free cash flow is much better. And then Netflix, most notably, has kind of raised its free cash flow guidance to almost $5 billion for this year. And that's all because of these labor strikes. They're not spending any money because content has come to kind of the screeching halt in Hollywood. The thing is, yes, it's fine in the short term, but yes, if the strikes do extend, if they do spill over into 2024, all of these companies, including Disney, are really going to be in a mess because, again, you need content, you need that for your top line growth, and that's not going to happen. With Disney, it's also even more, I think, there's a sense of urgency just because we've kind of seen a lot of their film titles, their recent film titles underperform. And so it's really important that they get that content engine, that they fix the content engine, which seems a little broken at this point, and kind of get it re-energized.
There does seem to be a lot of hype around movie theaters right now. I mean, we know why it is. I hesitate to say the names because I feel like we've uttered them so much of the movies these past few weeks. They've gotten people into the box office. Geetha, is there any read-through, or is it just two movies that has everyone excited, that had a huge marketing budget? Or are there any expectations of a revival of a consumer who wants to actually go see films in a theater?
Yeah, we've kind of seen this on again, off again kind of box office recovery pattern for many, many months now, Danny. And I think that's a really, really important point that you bring up. I think the key takeaway for the industry is if there is fresh content, people, first of all, are interested in seeing fresh content, original content, which is what we got to see with, both Barbie and Oppenheimer. And they've just done extremely well, not just domestically, but they're playing very, very well in global markets as well. And then you kind of contrast that to the likes of Disney, right, which comes out with, Marvel or, Indiana Jones or even some of its recent Pixar movies. They've just not done that well. And so there seems to kind of be this tiredness or this franchise fatigue, if you will. So I think that the real takeaway is, if these studios can come up with fresh IP originals, then people are definitely willing to, pay the bucks and go out in the theaters to watch them and enjoy them.
Geetha, I want to ask you a final question simply about that, which is that, and I would say the labor strikes as well. Let's fold in the concept of artificial intelligence here. If one of these sticking points of the labor conversations, of the way movies are made, is the use of AI, why are some of these media companies perhaps not trading on that kind of AI frenzy that you're seeing with some of the other stocks?
But they have to be careful, right? It's a very it's a very kind of tricky balancing act, if you will. Yes, they need AI to kind of cut costs, but at the same time, AI is, as you just pointed out, the sticking point with many of these writers and actors. They don't want AI to replace them, and so I think the way that these media companies have to position the argument is to kind of show how, by embracing AI, they can actually enhance creativity. They can enhance the imagination of these creators, and so it's something that they can, creators need to work in harmony and not necessarily view it as a threat. But that's kind of a difficult, I think, pill to swallow for a lot of the people in the creative community. So they do have to be careful. It's a double-edged sword.
Yeah, I gotta say, I don't think I would want to be a Hollywood executive right now. Geetha Ranganathan of Bloomberg Intelligence, we thank you as always for joining the show and previewing those Disney earnings for us. Coming up, a look at some of the market-moving events to watch throughout the day. Stick with us. This is Bloomberg.
we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Let's take a look at some of the stocks we're watching in the pre-market trading. This is the big one. Disney earnings reporting after the bell here. Already seeing a bid into the shares, higher by about 0.8%, trading at about, we'll call it $88 a share, 89 if you're feeling comfortable. Look, they're dealing with a lot here because just in the last 24 hours, we also got news about a partnership between Penn Entertainment, of course, the gaming company, and Disney's ESPN. And that, although fueling some of the Penn National Gaming shares higher by about 13% this morning, is fueling a little bit of sell-off in some of their competitors, like of DraftKings, for example, down about 6.4%, or even Flutter Entertainment following that lead. So seeing a little bit of some movement when it comes to the streaming space and, of course, the gaming space as well. Another major stock to keep your eye on, I would say maybe not a massive stock, but a massive story, if you will. WeWork shares, the ticker is WE, literally trading at 18 cents. On a percentage basis, of course, it's going to be a massive move down, about 17%, just given it's a penny stock. But what you need to know is that they are slumping. They're saying there's substantial doubt about the future. Is this the end of the era for WeWork? And remember, still, the majority shareholder of WeWork is SoftBank at the end of the day. So really keep an eye on the ramifications of that. And lastly, Danny, I'm going to leave you with this one. Lyft shares sliding down about, we'll just call it just shy of 8%, trading just shy of about $11 a share, posting their slowest growth since the pandemic. This is really interesting because when we got the numbers out of Uber, they actually posted profitability, a profitable quarter for the first time in their history. So seeing a real divergence between Uber and Lyft, but of course we know Lyft is just a ride-sharing company. Uber does a few more things than that.
Yeah, I think really the two events to watch. One, it's going to be those Disney earnings that you mentioned. The other one, 6 p.m. UK time, 1 p.m. if you're in the U.S., is that 10-year auction. $38 billion, Kriti, is what's coming up for sale. 3-year auction yesterday, that went off smoothly. There's going to be this question as to whether the yield is enticing enough on the 10-year, but then tomorrow it's going to be even a more difficult one, a 30-year auction. That one is usually even difficult to push through too. And Kriti, this is concerning, or at least the concern is the deficit in the U.S. Are they going to be able to get these auctions done smoothly when the amount the government is taking on in terms of debt just continues to grow?
Yeah, I think that 30-year is really the hard one, to your point. Remember, has those ramifications for what the rates do for longer-term assets like car loans, like mortgages, et cetera. So really keep an eye on that one. That does it for Early Edition. Surveillance is ahead. Tom, John, and Lisa are going to take you from here. Stick with us. This is Bloomberg.
like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Basically overdue for a 3 to 5% pullback.
We have seen extraordinary support from monetary and fiscal policy.
The data is starting to come in as we've been anticipating, very disinflationary.
At the end of the day, stocks do well in the long run.
The market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Stocks doing okay this morning, live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Looking at the equity market on the S&P 500, just about positive by 0.25%. Deflation in China, the focus this morning. TK, every single data print out of that country at the moment just seems to be fueling some kind of negative sentiment worldwide.
I agree to start there, John, and particularly to start there for the Western world. This is not just about China. It's do we impute their deflation, their disinflation over. John, we don't need a bunch of charts this early in the morning in August, but the vector of deflation and disinflation in China from the beginning of COVID, and boy, they did COVID differently than we did. But I'm sorry, it's disinflationary, and it gets you down to a run rate of a positive 1%, even with the present deflation. Even positive 1% is not good enough.
The divergence across the global economy is pretty remarkable. At the same time, the West, developed markets, Europe, the United States are finding inflation. Lisa, we have deflation in China, and I think as a lot of people have asked this morning, it's the right question. We're in it now. How long is this going to last?
And is this the bottom? A lot of people projecting that this might be the bottom of some of the price declines that we've seen in China, which could have a more inflationary period later on. The other point, though, is really important, which is the divergence of different economies. How much does China matter as a disinflationary force for the rest of the world at a time where places like the U.S. are moving away from importing some of their goods, and the EU is trying to be a little more aggressive, at least with some lip service?
And when we have budget deficits this big in the United States, Tom, with unemployment this low.
The budget deficit story is tangible, and that goes country to country, but I think there's been a lot of good work. Justin Wolfers was on with Steph Rule last night with MSNBC, and Brian Setzer of Harvard with some really, really good work. And John, it's real simple. We're micro-analyze and export goods out of China. Enough with the micro details. Look at the bigger picture is what these people are saying.
What time did you go to bed last night?
I didn't go to bed. I did an all-nighter.
Okay.
You know, Steph called me up. She goes, I got Wolfers in Michigan on. I said, I'll stay up.
Okay. So you stayed up till midnight?
I started it all nighter. Then
with a cigar. Good to know.
Yeah. The Telegraph publishes, and I read the Telegraph in the morning.
Good. Let's get to the equity market. Price action looks like this on the S&P 500. You get the sound effects from that cigar in just a moment, no doubt. We're up by 1/3 of 1% on the S&P. Yield to lower by about a basis point on a 10-year, Lisa, 4.01%.
It's a quiet day when it comes to the data front. I am watching at 7 a.m. the MBA mortgage applications in the U.S. at a time where yesterday, or 2 days ago, I should say, 30-year fixed rate mortgages, the rate on that raised the highest since 2000. That's how high we have gotten. How much does that really dampen some of the demand there? 1 p.m., the U.S. Treasury is selling $38 billion of 10-year notes. This matters. Yesterday, there was a very successful 3-year note auction. It actually gave a bid to the market to risk assets, some people have argued. Do we get the same kind of thing with 10-year notes? That actually might be more telling. And we do get some earnings, although albeit it is slower. Roblox and Wendy's before the bell. We'll talk all about whether our kids still use Roblox as much when they actually have other things to do. After the bell, Lionsgate, Wynn Resorts, and Disney. Disney, the big one. I want to hear what they have to say about how they plan to use artificial intelligence to replace some of their storytellers, some of their actors even, at a time with all of the strikes going on. This has been one of the most controversial areas, and I really want to see what they have to say.
Traded the last 3 years, Dave Portnoy. We'll talk about that a little bit later as well. Do you see that story?
How could I miss it? Yeah, exactly.
Isn't that cool?
Yeah.
I don't get it. I'll let you brief me.
Well, we'll talk about it a little bit later this morning.
Yeah.
My news this morning is that I've applied for a job at UPS. Some people might be happy to hear that. 175,000 all in.
That banner went out on the Bloomberg yesterday.
Hold up. As a driver?
175,000, yeah, by the end of this 5-year contract.
Don't you need a driver's license first?
I'm going to do that too.
Okay, just checking.
Get it all done, Bramo.
Okay.
Mr. Farrell, you've got to drive on the other
Lisa,
side of the road.
there's a sequence of things.
Really?
There's a sequence
You're
of things.
going there?
You've got to work in-house for a little bit, do some package sorting, and then get the US driving license and take it from there.
I can see you on 3rd Avenue.
Larry Adam joins us now, CIO at Raymond James. Larry, don't worry, it might take a while for me to get that gig at UPS. This is the line from Max Kentner over at HSBC. We remain pro-risk. Near recessionary expectations still allow for further positive surprises in the coming months. Is that pool of negativity still there for us to feed on?
You know, look, we think that the market's fair valued where we are right now. I still think that there's some risk in this market in the sense that we think you're going to still see a mild recession unfolding. And right now, I think everybody's just getting overly optimistic on both the equity market and the economy. And I don't think that's warranted because, like I said, there are some signs that we're looking at that still point to a recession by the end of this year.
Even the people who don't think we're going to have a soft landing think the data might look like a soft landing for the next couple of months, Larry. Where on the calendar do you think this starts to turn in a negative way?
I think by the end of this year, the economy starts to go into a mild recession. One of the things that we point to is that what's been holding this economy up has been the service economy. And when you look at some of the anecdotal evidence that's out there, I think you can see it soften. For example, everybody's been calling this the Taylor Swift economy, right? I mean, even the Fed has noted that in their beige book. But believe it or not, today's the last day of her concert here in the United States, and then it goes globally. When you look at theme parks, right, you start to see some softness in the attendance there. So I'd watch, as Lisa said, the Disney's reporting after the close to see if that trend continues. And when I look at restaurant activity, you're starting to see some less activity in restaurants. So again, I'm not looking for a major recession. I think it'll be the second mildest recession we've seen in the post-World War II era. But I do think that you are going to see a mild recession.
Larry, long ago and far away at Alex Brown, you would say to people, calm down amid the fears they have of investment. Right now, there's a fair amount of fear out there. What do you do with big tech if you own it and if you've got a capital gain? Do you have the Alex Brown patience of years ago?
We do. I still do like the tech sector. I think one thing that's been missing in these earnings is that if you look at the NASDAQ, keep in mind that the NASDAQ's earnings bottomed in the fourth quarter of last year. And since then, you've seen a rebound. And if you look in the back half of this year, you see some pretty significant increase in earnings. The S&P 500, on the other hand, that hasn't really bottomed yet. Maybe it bottoms this quarter, but more likely it could bottom next quarter. When you look at visibility, right, AI continues to provide that visibility going forward. And then from a valuation perspective, I don't think people take into account how much tech has beaten earnings on average. When you start to factor that in going forward, tech's not as expensive as people think that it is at current levels. So I still like tech going forward.
Larry, Lisa mentioned AI and Disney. I don't buy it for a minute. I think they got much bigger worries than that. But how do you extrapolate AI over to non-tech companies such as Walt Disney or Burbank?
I mean, I think it's all about productivity. And you've seen how productivity has really been helping with the efficiency of these businesses around the world. And I think that trend is going to continue because with this lack of workers that we have, you got to find a way. You know, we always say that CEOs are going to wait there for workers to come knock on their door. They're going to take care of that. And the way to do that is through AI. And again, that's a very broad term, but technology in general is helping to alleviate a lot of those pressures when it comes to workers. That'll help drive earnings. That'll help drive margins. And I think that's why we're not looking for a big decline in earnings at all, even if we do have this recession.
Larry, just to sort of underscore what you're saying, are you basically saying that a lot of the tech companies could act as havens in this next cycle, even if we get into a recession, that they will continue to perform, and they could be the defensive plays at a time of potential stress?
Well, I think if we have a recession, if we do have a market sell-off, which, by the way, I think we're going to have one, right? I mean, you tend to have 3 to 4, 5% pullbacks in a given year. We've had one this year. So I think it's time to have one, and we're in that seasonal time period where you can see a rolling over of the market. I think tech is part of that, but if you look through the day-to-day, the week-to-week, I still think that tech will provide that visibility of earnings, which does give you a little bit more of that haven, if you will, of a fundamental basis for being in that sector. So yes, I still like tech from that perspective.
Where do bonds fit in at a time when people are looking to the supply and the potential for the U.S. Treasury to sell an increasing amount of debt at a time where the deficit is at a level that it's never been when unemployment was this low?
Well, I mean, I've heard these concerns about the market not being able to absorb all this supply, and time again, it's been able to do it, right? In fact, if you look at our expectation that we're going to see a modest recession, I think that takes interest rates lower. In fact, contrary to what a lot of other people think that rates are going to stay higher for longer, we think the 10-year Treasury could get down to around 3.25%, 3.5% by the end of this year. So I think with rates, the 10-year in particular being around 4%, I actually think that's a good opportunity to get into the fixed income market as we sit here today.
Larry, where's your level on 12 months on SPX? I mean, we're seeing some really interesting amendments here. Uber bulls, bears who've missed it coming up. But even the bulls are tweaking flat to up a little bit. What's your tone on that?
So 12 months from now, June of next year, we think the S&P 500 is up at about 4,600. You know, coming into this year, we were much more optimistic than most people on the street. But I tell you, a lot of that Uber optimism that's replacing that Uber pessimism makes me nervous right now.
Okay, you're talking like a Baltimore Orioles fan. You're a Baltimore Orioles fan. Can you give me an SPX 5,000?
Maybe at the end of next year, going into the following year. But right now, I think we're a little bit more cautious. Again, once we get that pullback, you know, then all of a sudden there's upside in that. And I think, by the way, people have to understand that volatility is part of the fabric of the market. So I actually think that that's a positive if we do get some more volatility into this market.
John, that was a World Series 2024 call by
We'll ask
Adam.
him the question, Larry. Let's ask you a direct question. How does a man get suspended from his job for just stating the facts? How does that happen in Baltimore?
Look, I agree with you 100%. You know, if we all got suspended for that, I probably wouldn't be on your show today, right? We tell the facts, we tell the truth. That's what you have to do.
You've got to pretend that stocks went down last year. Is that the baseball equivalent of what's happening at the Orioles, Tom?
Exactly.
You know, for markets.
What's important
stocks went down last year.
Yeah, the people,
stocks will be up this year. They're always up. They're always high,
The people that grind this out every day in sports, I mean, it's a tough job.
I know.
I faked that. Excuse me. I faked at it, John. It's a really tough job. These guys are grinding this away from their families half the year, and they're getting grief from owners on this.
Larry Adam of Raymond James. Larry, thanks for that. If you're not familiar with that story, we'll go through that story for you in just a couple of seconds, Tom. So you've got this local baseball announcer for the team, the Orioles, and he's come out and stated the facts, which is they have a terrible streak against, is it Tampa? Whoever it is. And then he gets suspended.
The guys for San Diego do it every day. The guys for the Cincinnati Reds, I've been watching lots of Reds baseball in Cincinnati, Barry Larkin and all that. You know what? They all do it, and this guy does it, and he gets hammered.
It's amazing.
Yeah.
So I had no idea. Apparently the job is to be a propagandist, right? Is that the job?
In the old days, it was understood that you were hugely employed by the team and you said good things about the team. Same in hockey.
And is that still expected of you now?
I guess it is. I didn't know it was.
Isn't that ridiculous?
My favorite part is that he made his comments about their streak at the same time that graphics were showing
the producers made the graphic.
and 15
totally
the record versus the race. So it wasn't as if this was just sort of like, you know, this random, you know, castigation of the team.
If the New York Jets did this, the only one that could be in an announcer for the Jets is Alarian. He's the only one that would,
Mohammed would be negative about it.
He would if he lasts one day.
I find it amazing. Anyway, that's the latest from Baltimore on the Marcus side and the sports side as well. In about 48 minutes, we'll catch up with Victoria Fernandez across market about 7 a.m. Eastern time to talk about the data still ahead. Tomorrow, the big one, tomorrow morning, CPI, 8:30 Eastern time. Then on to Friday, it's all about PPI. And there is just a feeling, even from those, and I mentioned Citi a few times over the last few weeks on this matter, Citi expect, Lisa, the data to confirm the soft landing view, even though they don't expect it to confirm it at the end of the year. It's like the next couple of months may well play fun and games with hopes and dreams of the equity market bulls.
This is the problem with data dependency. And when people say the Fed will just be following the data, because so many people say the data will be a head fake and won't necessarily show a reality that's going to play out over a longer period of time, to the same point that you're making. It plays into the hopes and dreams of this perfect scenario that doesn't really happen very frequently.
I go to 3 months, 12-month annualized statistics. Japan's in deflation.
As you should.
Japan's in massive disinflation.
China, you mean?
China. Excuse me. Japan too, but
that was the conversation. That was 30 years ago. Different conversation.
No, but Japan's got low inflation. Cut me some slack. The answer's tomorrow. I mean, look at 3-month data.
No longer the early 2000s, Tom. It is
I forget the decades now.
China in deflation.
I wrote something down. I was married.
Sometimes I wonder.
John, I wrote a thing down the other day. I thought I was married for 30 years.
Wrong decade, Tom.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right
A
direction.
record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We're not going to see China go back to where it was. It's a very big component of the global economy. It's a consumer of all metals. But also, I think we've got to be minded by the fact that if we're going to build a better world for everyone, we need to invest in development, so all metals are important. Copper is the most strategic of all those metals.
Always great to hear from Mark Bristow there, the Barrick Gold president and CEO. On the metals market and the situation with China at the moment, the situation as follows this morning. They're in deflation. the country is at the moment, the economy not doing so well relative to some pretty lofty expectations coming into 2023. Here's the price action more broadly, starting with the S&P 500. We go to equity futures on the S&P, positive by 0.2%. Yields just about unchanged. The 10-year 4.0161% on a 10-year. Inflation data, that's tomorrow morning. Going into it, the dollar showing some strength yesterday. We're unwinding some of that this morning. The euro against the dollar, 109.77. And a lift for crude, Tom. WTI, $83 and about 70 cents.
It's interesting to see, and of course, all of it keyed off the data tomorrow morning. We'll give that to you. When's that, John? 8:30 tomorrow?
8:30 tomorrow.
Usual time. Michael
PPI.
will drop by.
You see the oil production figures out of the United States?
Yes.
The projections now. Yeah. We're talking like record high crude output.
Record high crude output that can take over from the rest of the world, Saudi Arabia included, at a time when a lot of people had written off this kind of trend.
Government forecast, Tom, could be getting close to 13 million barrels a day.
Yeah, it speaks to the cross currents out there away from the gloom that's out there right now. Sort of like what we saw with Eli Lilly yesterday, which was a bang-up earnings report. This is the conversation of the day on China. Kaiyu Jin is at London School of Economics for this summer. Her book, The New China Playbook, is a definitive and abrupt read on her China. Professor Jin, I'm going to cut to the chase, and I'm not going to mince words about it. You nail it. With a deficit of demand in China, there is an ancient Communist Party calculus of what you do with a deficit of demand. Do those formulas, do those processes still work to boost demand?
Well, the Communist Party doesn't really believe in short-term demand-driven stimulus, so it's taking a very different route from the Western governments. It's still focused on supply. It's about long-term. It's about harnessing resources for the long-term strategic goal of technology and high-tech. So they're not that interested in short-term demand stimulus. They're trying. They're setting the tone, a warm tone for the private sector. But it really is up to the private sector and the entrepreneurs to fend themselves, really.
I spoke years ago to Jean-Claude Trichet about the dispersion, the diffusement of productivity in Europe. How does Beijing disperse the message to boost demand? Do they do it federally out of Beijing, or do they do it city by city, mayor by mayor?
Well, actually, Tom, you mentioned a really important thing here. That's the political economy problem or advantage, if you will. The central government sets the tone, but then it's up to the local governments to implement, apart from the large macro policies. And there's a lot of things that can go wrong in the implementation stage. So even if the central government wants something to happen, it doesn't mean it will be delivered.
Right now, there are reports that the Chinese Communist Party is going after academics, economists, other people who use the word deflation, who talk about the negativity of some of this data. What do you make of that? Does that make it a better situation or a worse situation to really grapple with the task at hand?
No, absolutely. I mean, if there's no transparency on information, on how the economy is doing, actually everybody on the ground knows how the economy is doing, but if the leaders can't see it, that's a real big problem. The question right now is economics need to be the focus. China has totally lost the momentum of the last 10 years, and if it doesn't sooner, then we can't really talk about other things like, security, like social stability. So that's got to be the focus. And like you said, there's just much more control on economic discussions and not enough transparency. And I think it's a huge disservice.
And we've heard there are reports that even business leaders who go to China to have discussions are really managed, and they feel like they aren't allowed to have honest conversations with people at a time where there's some real concerns around the housing industry, another developer at the potential brink of default. What do you make of the inability to have free discourse and what that does to actually grappling with the real issues right now? I ask this specifically just to build on what we were talking about, with the idea that if you do not have a social spending, a social mobility, a social employment, especially for younger people, are we entering a lost decade similar to what we saw in Japan?
The lost decade is possible, but not for the same reasons as Japan, because we haven't seen in China a big asset price collapse. We haven't seen that yet. But I would want to say that people are very clear what's going on the ground. The private businesses, I'd even say the policy institutes and the government at some levels understand very clearly. We just don't know how much the top leadership gets it. So my suspicion is, things are just done. There's policy, there's reaction, there's reality. There could be a big discrepancy. Look, the economy is sluggishly recovering. Even if we can't talk about things openly, they're closed-door conferences. Investors make their decisions based on information. So,
Professor, all Americans have a legacy of a certain vintage of how incredibly wrong we got the breakup of the Soviet Union. And we did so because we had the wrong intelligence, the bad intelligence, not enough intelligence. From where you sit in your purview, do we have good intelligence on the political economy of China?
I think by and large, no. It's a very unique structure, how decisions are made, how things are implemented, the divergence of interest within the party. Like we said, the setting up of the strategy, but the implementation, there's, huge discrepancy. And even internal mechanisms of competition, of accountability, all of that is rich stuff. China is seeing a lot of problems and challenges right now, but there are also advantages. It's just that China's entering a new stage. The state needs to step back.
It's a difficult stage. Kay Eugene, thank you for the update. Kay Eugene there of the London School of Economics out of Beijing this morning. It's been a difficult week for the economic data out of China. The trade data was terrible. And the inflation data, Tom, we should call it deflation data, given what we've seen this morning.
And it's a rich set of data, and what I would go is where a lot of people, including Dr. El-Arian, went, which is foreign direct investment into China, the lifeblood of technological advancement of China through joint ventures. And I'm old enough to remember, John, when this was a whole brand new idea, joint venture between a Western, the British will go before us, a Western company, and Eastern. They didn't work out, but the answer is, where's FDI? Our input into China's evaporated.
Well, the criticism, what the criticism has been. Joint venture, you be our partner, and then what happens down the road?
Oh, yeah.
We take your technology,
case
your
after
IP,
case.
we no longer need you anymore. And the United States, 20 years later, has decided to do something about some of the investment going into China. But we found out month after month over the last 12 months that this outbound investment restrictions that's going to come out of this administration is going to be a whole lot more narrow than we thought it would be. Secretary Yellen spoke to Anne-Marie down in Washington in the last month or so. AMH has gone missing over the last few
lived
days.
in Europe for 2 years, and she thinks she's on a holiday for
and
a
Secretary
month.
Yellen gave us a strong indication, Lisa, that it would be a lot more narrow in scope. And we're learning this morning that it will be, and potentially unveiled later this week.
Specifically trying to restrict investment in companies in China that have artificial intelligence related to military capabilities and very specific types of computing. So there is something a lot more sort of nuanced here at a time where they don't want, the U.S. doesn't want a total divergence from China, but to curtail some of the competition that people have thought of as harmful.
I think research is in order, and I just think the three of us on the deck there, up 7 floors at the Peace Hotel on the Bund in Shanghai.
Yeah.
Surveillance from Shanghai, from
Is that
Asia
the pitch?
would
Is
be
that the
good.
pitch?
3 of us. We could pick the Bramo cam if it could get through customs.
Can I just say that surveillance would take on a very different meaning on the penthouse event?
Yeah,
Very good.
I'm not sure we'd be able to say that on air, would we?
Exactly. No, I don't think so. But I do think it's an interesting moment. And I think, we're talking about the deflation numbers. China export prices saw their biggest drop in a decade.
A fifth.
Just amazing.
It's a big move. Marvin Lowe's going to join us shortly of State Street. Looking forward to that conversation. Equity futures on the S&P positive by 1/3% on the S&P 500. In the bond market, yields pretty much unchanged. Your 10-year, as it has been over the last couple of days, in and around 4%. From New York City, good morning.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
The conversations at the commercial breaks are always better. Sometimes you get Southside calls. You get single name calls sometimes as well when guests don't think they're on it.
That was gold.
That was fun yesterday, wasn't it?
That was really good.
Yeah.
And then walking off, just take the mic, be like, all right, I'm
Charter
done.
at Deutsche Bank with a single name call, Tom, on
Mr. Saving,
Apple.
Mr.
This isn't on, is it?
Please, Mr. Savings, the Binkster believed in the market at the bottom. Don't forget that.
I agree with
Mr.
that, Tom. It's just a joke. It's all right. You're allowed to make jokes. It's okay.
No way.
Equity futures on the S&P. You would never. Up a third of 1% on the S&P. There's a lift in the NASDAQ. Up a third of 1% also. The Russell, the small caps bouncing back as well. Up by 0.42%. The main event a little bit later on the earnings side of things. The Walt Disney Company after the close. In the bond market, 2-year, 10-year, 30-year, 3-year debt issued yesterday. Went okay. 10-year debt today. That's when the test begins. 30-year debt. That gets supplied tomorrow coming out of the Treasury. So your 10-year right now going into it, 4.02%. Lisa on a 30-year, just short of 420 at the moment. And down, let's call it a single basis point.
All eyes trained at the 1 p.m. auction of 10-year notes. I do think this is going to be important because what we saw yesterday, the 3-year note was not the point. That was sort of the appetizer that was just really speaking to short-term yield space, which doesn't really have a significant impact. It went well, and you saw the immediate read-through in the broader market. Just imagine what that means for how sensitive the market's going to be, the broader risk market to 10-year.
Can you see her at a bar, bringing a bar to a complete stop?
At 1 o'clock later. Yeah.
With her enthusiasm on the 3-year auction.
I am
changing the network to Bloomberg in the bar.
Turn the Mets
Everybody
down.
stop.
Turn the Mets
Get
down. This is
ESPN
worse.
up. I want to talk about the auction.
They wouldn't be
You ever do
missing
that?
much. Yeah, that would be good.
I go into gyms and turn the change the
Yeah,
channel.
I actually do that
all the time.
Not
I do it all
bars
the
at
time.
1 p.m.
Just put my face all over the gym and the promos.
That
And the
was fun.
surveillance this morning. You believe that, don't you? I do. China, sliding into deflation, consumer and producer prices falling together for the first time since 2020, signaling a worsening outlook for the world's second largest economy. CPI registering its first decline, Tom, in more than 2 years. PPI down for a 10th consecutive month. We've seen this for a while now developing.
It's not the same inflation statistics as we have. The key variant there is pork. I used to make jokes about it, except it's really, really serious in China, feeding people. And they're getting a pork and a food and a chicken disinflation here as well. So it's a number of things linked in together driving the vector down.
Speaking of food prices, Lisa, rice prices. You see that headline this morning?
I did. Rice prices surging, and you have this potential for that to affect a broad swath of land. How do we factor these kinds of things in, especially because people are just basically saying commodities are going to be in the back view mirror, and they're not. I mean, very much, whether it's crude, whether it's wheat, we saw that recently, or now rice.
Just under the radar, Tom. Just creeping up on us.
Not on
This
the radar,
commodity
but
move.
not to these worlds. I did a lot on this 15 years ago. Thank you to the United Nations in Rome, Italy, that are brilliant on this. And the answer is this is deadly serious, no pun intended. And for certain nations, their answer is we need to fix this now. Rice, when rice moves, it's done 3 times here in recent years, up to where we were in 2008. The answer is when it moves, conversations are had immediately.
Prices the highest since 2008. Well, let's turn to this story. A U.S. plan to limit investment in China will be less restrictive than originally expected. The executive order expected to be signed by the president this week will likely apply only, Lisa, to Chinese companies that get at least half of their revenue from sectors such as quantum computing and AI. All of this according to people familiar with the matter. So if you thought it was narrow a couple of months ago, Lisa, I imagine it's even more narrower to you based on the news we've got now.
Yeah, and you framed it right. There really raises a question of where the conviction is for this administration to really go after some of these bans and institute them in a more meaningful way versus try to make peace with the world's second biggest economy. And that has been sort of the tension underpinning the recent diplomatic forays into Beijing. And it also has a very much political tinge where how do they signal one thing and do something else? I mean, basically, that's essentially what some people are talking about.
Last story this morning, this one. First-year analysts eat your heart out. UPS drivers could make $170,000 a year in annual pay and benefits thanks to a new 5-year contract the company tentatively agreed with the Teamsters Union in the last few weeks. Before becoming a driver, though, here's the caveat. Employees first have to work inside the building as a package loader for several years, and those jobs, Lisa, pay less than are mostly part-time. Now, this is going to be at the end of the 5-year contract. So what's that, 2028 going into 2029, but 170,000 for a UPS driver.
3 things. Coming out of the pandemic, we needed our packages delivered even when everybody else was home. You can just imagine that people are now saying, you need us, you don't have enough of us, so guess what? Pay up. Second thing, we will effectively get those costs in higher rates. And we were hearing that from Lee Klasko of Bloomberg Intelligence yesterday. That will directly feed into higher costs of shipping, which I think is interesting. And the third thing I want to say, who is next, given that wages are rising? The United Auto Workers Union pushing back, proposing $46 billion of raises. I mean, at a certain point, if you want workers, you've got to amp up your salaries. If you want consistency, what does that mean? I mean, that's kind of the inflation story.
Underreported right now, and it was in our conversation with Sean O'Brien of Boston and the head of the Teamsters, is how he became head of the Teamsters. It was a massive uproar, good enough for Hollywood and the movies. He was the underdog, came in, and he won because he went with a little guy at the Teamsters. This was a little guy victory, John, at the Teamsters. I don't know if there's a British equivalent or a European equivalent, but this was an absolutely original triumph of the Teamsters. And there's a massive labor, now what, off of what Sean O'Brien did.
Best take I've seen on this in the last 24 hours. This will be the last contract they signed. Because in 5 years, UPS are going to invest so much in robotic delivery, Tom. So much, because who on earth can run a business paying the delivery driver $170,000 on average? It's too expensive. So there is a feeling for some people, and I saw that take on Twitter, and I forget who it came from, so I can't cite them directly, and I apologize to that individual if you're watching this morning. But ultimately, there is a belief that this is a short-term move to satisfy things right now, but Lisa, over the long term, if you've got a labor-intensive business and that's the salary, is your business viable in 5 years' time?
A lot of people are wondering whether this also bleeds through to the service industry, too, where you have seen this, right? Where you order on a tablet and then somebody brings it. I mean, all of the efficiencies to try to reduce the number of people that they need to be wait staff.
TK?
I'm just wondering what's FedEx do? I was in my head. It's come out. It's an August pause. I don't start the tang, and my doctor hears me not starting the tang until 7 o'clock. John, what does FedEx do? You're a driver for FedEx?
It's going to be a difficult 5 years, I agree with you. I just wonder how many jobs actually get posted for drivers at UPS from here on out. That's going to be a really difficult job to get.
Yeah, we'll see.
We'll see how many openings there are, and good on them, too. By the way, I'm sure they're exceptionally happy with that, as they should be.
No, we're gonna have to see good reporting there by our team in Michigan. Right now, futures up 13. The VIX comes in from a 17 level, better statistic 15.64. Marvin Lowe knows as senior global market strategist at State Street, watching the ebb and flows of an August. Are we in August doldrums? Are we in the summers that you and I remember in our academic studies? August is weird.
August is weird. I certainly wouldn't say that we're in the doldrums, but keep in mind that we are in August liquidity. Be around during the third week. It just contributes to the volatility that's ultimately out there.
We had a guest on a little bit earlier who was talking about short-term demand stimulus and how China doesn't like short-term demand stimulus. And I was sitting there thinking, well, local governments do, don't they? Yeah. And their struggle right now is that they can't lever up. Yeah. So what's going to happen going forward from here? You've got a property market that's seizing up. You can tell me how bad you think it is right now. And you've got local governments that can't lever up to help hit those growth targets. What's going to happen?
Yeah, I mean, certainly the property market took a few steps back again. With problems with again some of the larger property developers out there. That does provide a lot of the collateral for the stimulus that people think is easily put out there, and I don't think it's that easy to put out there. And ultimately, all of the concerns that we're seeing around the property developers also ebbs down to the actual consumers of that property. So, our kind of people that are that generally have bought these homes willing to go down that route again, given everything that's happened. I think it means that the amount of growth and really expecting a quick bounce back, because China has typically put a lot of stimulus into the system during periods like this, might not come the way it typically has.
We talk about the property market. Country Garden Holdings, which is a bigger developer than even the Evergrande Group, has missed a payment, and people are wondering whether they're going to make it in the 30-day grace period that they have left. I'm wondering what disinflation in China or deflation in China means for the inflation picture of the rest of the world. Is there as much of a connection as there has been traditionally, where lower prices in China will drag down prices elsewhere?
Yeah, that's kind of where I focus on the China story. How much of it makes it here? It will have an impact for sure. It'll have an impact on the good side of the discussion, which is already collapsing. We do see broader consumer demand for stuff, if you will, not necessarily services, but for stuff really coming down. That's driven a lot of the inflation discussion. But, the focus from the monetary authorities, the focus really is on some of the stories around UPS, around wages, around the services part of the discussion. And that kind of last mile part of the inflation compression, disinflation, however we want to look at it, could be much harder won than the good side of things, where we do see that demand coming off, and it continues to come off.
Can I go to a kitchen table question?
Of course, it's
I
your
got
table.
a chart of Standard & Poor's 500 and MSCI international indices, whatever the indices, doesn't matter. Back to the 2007, the credit crisis. It's been one big fail for international markets. You're a global strategist. Can you tell American investors to get off the Standard & Poor's gravy train and go international?
You know what? I would look at it from an asset allocation perspective. Certainly, there's more value in a lot of the international markets.
Are you going to get a sharp ratio pop here if you diversify into international?
Not that much. And from a margin expansion perspective, from a company beat perspective, the U.S. is still leading that discussion.
Where's margin expansion going to come from across this equity market, given the UPS conversation that we just had? And I'm going to cherry pick some companies. JetBlue, Southwest, talking about flagging demand domestically, a loss of pricing power potentially, and at the same time, we're talking about a labour market that still has leverage. What happens with margins in the service industries?
Yeah, I mean, certainly that's probably the correct discussion, thinking about next year. This year, the earnings estimates were pretty easy. We went in with low single digits. We're going to wind up with probably low single digit losses. It's not, it's within the realm of possibility. Next year, we expect 10+% EPS growth, and a lot of that is going to be margin expansion. I think you have to look at the companies or sectors that are able to either have top-line growth and or expand margins. Tech does come to mind, even though valuations are tough. Healthcare, from a valuation perspective, probably makes a bit of sense. And some of the work from our equity team, really focused in on the energy discussion from both a top-line and margin perspective. So I think that's how we approach next year, just really looking at those industries that might have, a bit of a moat that they can defend.
Are you worried about losing analysts to UPS in the next couple of years? It's quite a salary, isn't it?
I mean, at those levels, I might not have gone down this route.
Marvin Lowe, Senior Global Market Strategist at State Street. Game-changing, potentially, Bramo.
But that's the point. Nobody wanted to say that their child was training to be a truck driver when they were, like 10 years ago. And now we have no truck drivers. And all of a sudden, that's a big issue. And there's this whole dearth of them. And guess what? They're crucial before you get to the autonomous driving trucks. And who knows whether they'll be cost efficient to actually make it work that means less than $170,000 a year. I'm just saying, it's sort of this reality check of the physical economy. And now it's coming to roost.
And also, to your good point, you take 170, 175, and you knock out 30 grand for benefits. So all of a sudden you're down to a 130, 140 pop out. How many years, John? 5 years out?
In 5 years' time, yeah.
Do the math. I mean, I get it. It's a pop, but it's not that big a pop, when you adjust it for some of the realities.
It depends where you live, TK.
Oh, no, I get it. It's a pop, but come on, 5 years out, and you got to... This is a major thing. People don't factor in benefit costs like ECI when they're looking at salaries.
And that is all in, and you're right to point that out. Yeah. That is all in. Yeah. It includes benefits. 7:30 Eastern Time. Right. Mark Cabana of Bank of America coming up shortly. Marvin, thank you. It's good to see you. Your equity market on the S&P 500 positive by 0.25%, live from New York City. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And the Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain. There's a lot of talk over the last few weeks about the potential for what is often called a soft landing. Certainly last month's inflation read was a good one, and I hope it's a sign. Because, to be sure, the Fed's objective is not to cause a recession. It's to reduce inflation, in line with our mandate.
That was Tom Barkin there, the Richmond Fed president, does not have a vote this year. Patrick Harker of the Philadelphia Fed does have a vote this year, and he indicated a similar thing. They're embracing the prospect of a soft landing, and Tom, we might be on the flight path to one this year.
I still don't know what a soft landing is. I just, how many times have we gone through this? 3 times, 4 times? V-shape, all this other baloney. Soft landing, what is it? Just describe what it is. I guess they're looking for, what Greenspan would call quiescent inflation and not a 6% unemployment rate. Put it in the pieces is better than
in simple
whatever
terms,
in God's name a soft landing.
A return to 2% without a recession. In very simple terms.
I'm going to listen to Vice Chairman Clarida. He says, maybe not.
Except 2 point something.
2.x.
I think the Fed's view on it is precisely that.
Yes,
the Fed's view is, can we sit here and be convinced we are on a path back to 2% without a recession and then back away? And will we call that a soft landing and dance around Jackson Hole, Wyoming and run around clapping hands, Tom, and, doing high fives?
You know, I agree, but we're going to be at Jackson Hole in the bar.
What are we going to do? You know, that walk.
You know,
do a high five, well done.
Woo, yeah.
Way too early
probably
for that.
gonna, you and I will be sitting at the bar, and
job,
the
Jay.
Fed president's next to us, and
Then they start whispering.
they start whispering, and John's taking notes, and you know, this is how it begins. Right now, we're going to go technological here. Mandeep Singh joins us, senior tech analyst at Bloomberg Intelligence, on all sorts of things that are out there right now. How do you, as the adult, not only in the room but in the building, how do you respond to the idea we're going to keep AI out of China? It sounds, to me, as a complete hack, it sounds completely sophomoric. How does an adult respond to that political statement?
I mean, look at how all these large language models are built, right? They are scraping all sorts of open internet data, you know, that's available on the web. In the case of China, they monitor everything. In fact, they restrict your ability to even scrape any type of data to build, you know, a large language model. So I feel now that they have realized that, you know, obviously generative AI is the new big trend, they're trying to catch up. But in terms of what they have done so far, clearly, I think data is an issue. Then the export restrictions when it comes to getting the latest equipment, that is an issue. And so they're clearly a few years behind when it comes to especially this trend of generative AI.
We're talking about generative AI ahead of the Disney earnings after the bell, and Tom thought that I'm making too much of this, but I know a lot of people who work in the industry who are thinking about, does this mean that their job will be in jeopardy? If you're a backup actor, does that mean that you're going to sell your image to someone they can use in perpetuity, and that you just can sit on the couch and do nothing? Are we looking at that type of AI future?
I mean, content IP really matters when it comes to generative AI, because all you're doing with generative AI is making it easy to do permutations and combinations and really come up with new sorts of content that leverages existing content. Remember, generative AI is built on training data, vast amounts of training data. Where do you get this training data from? It's coming from existing IP. So anybody who owns existing IP, whether it's Disney or someone else, they definitely have an advantage because that's what is going into training. I mean, you could argue, like, why are these companies leveraging my proprietary IP for training their algorithms? And I think there is a case to be made.
We're talking about the reality of artificial intelligence at a time of increasing labor power. And we were talking about the potential for automated truck drivers and things of that nature, automated trucks. How close are we to that type of reality at a time when you still have ride-sharing services that are very much dependent on the humans that drive them?
I mean, clearly the large tech companies are investing, whether it's Amazon through Zoox or Waymo. I mean, we know Tesla has ambitions in that space. So clearly they've been burning a lot of cash and investing in it. And look, these things take time. I mean, generative AI was in the works over the last 5 years, and then it had an inflection suddenly. So to my mind, the key to this is training the algorithms, getting that 99% accuracy or even more. And that's what will take us there. And it's not going to happen, you know, over a weekend. It will take years. And I think there is incremental progress right now. Clearly, when it comes to marketplaces like Uber, Lyft, their entire business model is built around supply acquisition. Well, guess what? That supply acquisition is worthless if you have autonomous driving. So those business models could be completely disruptive if and when we get there. And I think that's what market is watching out for.
Autonomous driving on the FDR.
Yeah, can you imagine that? Yeah, okay. I'll be pretty nervous about that. It's getting expensive, Mandeep, I've got to say. Uber, it's getting pricey, isn't it?
Not with Lyft, though. Not with Lyft. Last night they said their pricing is going down 5%.
So I need to switch to Lyft, is what you're saying.
That's their play right now, that they're lowering their prices so that they can bring back the volume. And I think that's a struggle they're having.
Do Lyft grade you? Do they give you a rating?
Yeah.
In the same way that Uber?
Yeah.
They do.
They're commoditized services,
Really?
you know?
Well, I've got a good rating. I just hate being graded as I get in the car.
Because you feel pressure when you walk in?
No, just, you know, I am who I am, and I'm 496, and that's good, and I'll take that.
I have
you want 5, and part of you bothers you.
No, I just don't want the feeling, you know, I'm going to behave the way I always behave, whether it's a yellow cab or an Uber, but I just don't like being a consumer of a good or a service and being rated. at the same time. But, you know,
I have a
just
half
my
star
view.
rating.
Your rating's terrible. Let me tell you what happens when you get an Uber with this guy.
I've seen the other side of it. Well, there's this.
Chevy Suburbans aren't big enough, right? There's a particular model that you don't like. What model is it?
The newer ones I hate.
The newer models. Okay, so if a newer model pulls up, doesn't even say hello to the driver, opens the passenger side door,
Got that right.
gets in, yanks the chair forward, criticizes the new car and says the older model was better, gets in the back, doesn't even say hello. And every time we do anything together, I have to apologize on behalf of us both.
So will you ever
doing that
get
for 50
hold on.
years.
This is the key. Will you ever get an Uber on your credit rating?
No.
With Tom?
Absolutely not.
Okay.
Never.
I mean, that's something it's a
never,
consideration.
Question in here
ever
to Mandy.
order
Yeah.
the car.
On radio and television, Mandeep Singh. I want to talk about Bertrand Sigwin, who's got an app economy insight, lighting it up in your world of technology. He's got a chart today on cloud percentages. Amazon, Microsoft with a little bit of an upslope, Google with a good upslope. Do you just assume it's a triopoly 5 years out? Because IBM ain't getting it done.
Yes, I think these are the companies that are spending the most when it comes to building the infrastructure for cloud, and clearly that's an advantage. But I wouldn't rule out, likes of NVIDIA coming out and,
NVIDIA doing the cloud?
Doing the cloud, because they could get disintermediated. If Amazon is developing their own TPUs or their own chips, or Google is doing the same, then they could get disintermediated down the line. So they are better off, going vertically up the stack.
I was disintermediated out of Uber.
Mandeep, thank you. Mandeep Singh of Bloomberg. I'm with Lisa. I'm looking forward to these earnings from the Walt Disney Company a little bit later. And the path forward here on the AI front for programming and for media is absolutely fascinating. And I would argue, Lisa, it's been going on for a long, long time. If you think about how they developed House of Cards on Netflix years ago using big data, this has been in the works for years and years and years. And you get to that point where it's starting to climax, workers start to strike, and this is where you've got to make some tough decisions.
So where does the investment go? Who do they hire on the AI front in order to do that? And then how do they bring workers back in the short term who are striking, particularly because they want to understand with some clarity what their revenue stream is, not just from AI, but also from some of the streaming networks. The reruns there are different in terms of royalties than in the cable reruns.
I don't agree with this AI chat in Disney. They're sitting in the boardroom with Iger going, what are we going to do about Barbie? That's all they're talking about. I mean, they're doing nothing else except saying, where's our Barbie? What are we going to do? What's a JV with Barbie?
Yeah.
I'm serious.
And ESPN as well. They'll be talking about that.
Oh, yeah, ESPN's, I agree. You're big on that. We're going to get a brief from you on that.
We are in the next hour.
Yeah.
We're going to have that conversation on what could be trade of the last 3 years for Dave
Dan?
Portnoy.
Is that what you think? Is that what you think? Hold on a second. Is that what you think?
That's what they're doing.
Sorry, Grandma. What did I do?
They sit around Barbie.
No, they're like, Barbie brought in $1 billion. Where's our Barbie? Somebody's saying there right now, Roy Disney's saying there right now, where's our Barbie?
They will be incredibly disappointed that they don't own that franchise and weren't behind
And the process to get to that franchise.
I would agree with that, yeah.
I don't think I'm being cynical there. It's just Hollywood history.
But how many Marvel movies
I mean,
have they got in the
people
pipeline?
all over, globally, people are going, where's our surveillance? They do that every day.
Yeah. Is that what they're saying in the boardroom? Where's our surveillance?
Where's our surveillance?
Even you're not saying that seriously. They should be. Victoria Fernandez across marks coming up soon. Mandeep, thank you, and sorry, all at the same time. Equity futures on the S&P positive by 0.2%. In the bond market, yields just about unchanged. Your 10-year in at around 4%. The runway through the rest of this week. Inflation data tomorrow. Consumer prices. Then factory gate prices, PPI, on Friday. From New York, good morning.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are basically overdue for a 3 to 5% pullback.
We have seen extraordinary support from monetary and fiscal policy.
The data is starting to come in as we've been anticipating, very disinflationary.
At the end of the day, stocks do well in the long run.
The market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Got everybody sending in their Uber ratings. Only the people who've got ratings at 5, right? Yeah, exactly.
People
Everyone else is like, let's not talk about that. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive by 0.2%, but it's another morning where we have to start today, Tom, talking about the data out of China. Earlier this week, it was the trade numbers, not great. This morning, deflation in the world's second largest economy. Just to compare and contrast there. Growth bad, deflation to here, growth good, inflation. It's just amazing to see.
There's some really good charts out there. The FT had a great chart showing 5 or 6 nations, including Japan, with those. I just look at the vector over 3 months or 6 months, and what it says to me, forget about the emotion of deflation. It says disinflation in China, disinflation in Japan as they unroll from YCC. And we don't really have a vector yet. We have sort of a rollover. UK doesn't even have that. They got a big asterisk next to theirs, which is we're going to lose Harry Kane. But other than that, there's the basic idea that we need to still prove disinflation as we go to those numbers tomorrow.
In China right now, there's 2 questions. Can they, Lisa, and will they stimulate their way out of this?
Right, and I think the can they is a key question because people just are not spending the savings that they have. They are saving more. They are not buying properties. And you continue to see that. On a larger scale, this really raises a question of what kind of disinflationary force it is in the rest of the world. On the good side, yes, we are seeing that, and even outright deflation. But then on the commodity side, you're mentioning rice at the highest prices going back to 2008, oil prices, gasoline, all of these types of features that go in that really lead to a separation of the U.S. and the Chinese economies.
Got a great guest coming up, so let's turn to the price action. The S&P 500 positive here by 0.2%. What's that number, TK?
It
What's your
says
rating?
plus 5.0.
That's not
I
right.
didn't even know how to look it up.
Okay, you're going to pass over your phone in a minute, and I'm going to find your rating on it.
He has
There
a
is no,
5.0
he's
rating?
not 5.0.
Seriously?
Let's get back to the bond market. He's not.
It has an asterisk next to it. I don't know
Get back
what
to
the
the bond
asterisk
market.
is.
4.02% on a 10-year. Lisa, in the FX market, euro bouncing back a bit stronger here, 109.78.
All right. Well, we are waiting for those MBA mortgage applications that are supposed to come out any minute, and it comes at a time where mortgage rates are the highest level going back to 2000. I keep thinking of that, well north of 7%. How many people still want to borrow to buy homes, and what price do those homes have to be given how high mortgage rates are? Then at 1 p.m., this is the key event. U.S. Treasury is planning to sell $38 billion of 10-year notes. Yesterday, there was a pretty constructive 3-year note auction. It wasn't that big of a deal because it really isn't the longer duration tenor. That's just because it was the appetizer, Tom. It's not because people didn't care. And the market still responded, which gives you a sense of how they could respond
I'll give
to
you
a
that.
10-year auction.
I saw the response. You're correct. There
Thank
was
you.
a response.
See, it matters. And today we get a bunch of earnings. We just got Wendy's, actually, which looks like it's a bit disappointing, and we can get into that later. We also get Roblox today before the bell. After the bell, really the key thing will be Disney, which has underperformed pretty dramatically this year, up only 1.4% versus a whole host of other companies like Wynn and Lionsgate also reporting today up more than 20%. I really do want to hear what they have to say about AI, investing there. ESPN, we haven't even talked about that yet. Investing more in sports betting. How are they going to pair that with their sort of very pure family-friendly image?
Okay, it's 5.0, but it's Lyft. Uber's deleted. It's erased the app.
Yeah.
Okay, how many times have you used?
Uber is
Hold on a
not
second.
on the phone.
Hold up.
That's the second hold
The
on
only
the second.
time I use, the only time I use
like
Uber is in
grandma this
Paris.
morning is just like back
Well,
of the hand.
I'm just, it's a Wednesday, I think. Tom, have you ever used Lyft before?
I use Lyft all the time.
And you've got a 5.0 rating.
I guess I do. I never look. They're so rude to me that,
Okay.
that,
Victoria Fernandez is with us around the table, Chief Market Strategist at Crossmark Global Investments. Victoria, good morning.
Good morning.
Not going to ask for your Uber rating this morning. Going to talk about your price target on the S&P 500. It's amazing for me that we've seen this data come out of China. And typically years ago, what we would have seen on a morning like this morning, through this week, is just an aggressive rally in the bond market, yields much lower. We'd be talking about China exporting deflation to the rest of the world. What's changed?
Well, I think we have to look under the hood a little bit on this China data. Yes, the headline numbers are down and we're seeing deflation there or disinflation, but the core number is actually the highest it's been since January. It's the food prices in China that brought down that headline number. You had pork prices up 26% in June of last year. They're flat this month. So we have to look a little bit more and see what is driving it. Typically, you would see a response, but I think because that underlying core inflation, which is the concern here in the U.S., what is that core inflation going to look like? Is that going to remain sticky, especially with wages? That's going to be the concern.
I'm so happy you're here. Crossmark has such a pulse on what people emotionally are doing with their money right now. Institutional, high net worth, and the whole thing. What's the fear level out there, meeting to meeting at Crossmark?
Yeah, it's gone up definitely over the last quarter. Each meeting that we have, people are concerned because we've been telling our clients, we think there's going to be some choppiness here. We think we're going to see a pullback in the fourth quarter of this year, so we need to be prepared for that. So they're getting a little concerned. What we've seen as of late, though, is more people wanting to go into the bond market. They see these yields. They think that we're probably at peak or close to peak in bond yields. We were, 4.25% in October of last year. We think that's the peak for the cycle. So if those yields start to come down, they want to add some duration in their fixed income market. So we're seeing that there. But they like the fact that we're being cautious a little bit in the equity market. We're invested, we're in there, we're getting them a good return, but we're being a little bit cautious as to where we invest.
So I just want to go through the chronology of this year. It was, I believe, a soft landing, then a no landing, then it was a hard landing in March. John, you've been very good about documenting the different narrative shifts. You're tracking it. Now we're in soft landing. Do you buy it? Are you basically leaning in that there is this idea, just to use divine soft landing, that we could get back down to near 2% inflation without unemployment rates really rising all that much?
I don't think so. I don't think we're going to be able to have whatever the magic is, the sparkle dust that's going to make that happen for us. I mean, we assume that the Fed, we're close to peak Fed funds rate. Are we there? I don't know. I wouldn't be surprised to see the Fed go another 25 or 50 basis points. When you look at some of the inflation numbers, you look at average hourly earnings over the last 3 months, it's up about 5% on an annual basis. If you look at just the goods producing sector over the same time frame, up 7%. We've got the UAW, their contract ending in September. We could have wages go even higher then. So I think there's some underlying pressure on inflation that's going to continue to be there. And you have an economy that is doing pretty well because the consumer is there, because the labor market is strong. So at some point, we're going to have to pay the piper for everything that we've seen up until now. I think we could start to have a consolidation around a 4,200, a 4,300 on the S&P, take us back another 5%. To us, that's your opportunity to get into the market.
Are you staying away from companies where there is strong labor negotiations or a potential risk there for either shutdowns or a significant increase in some of their compensation costs?
Yeah, I wouldn't say we're staying away. We're not pulling out of those names completely, but we could be a little underweight in those names. And if we start to see more pressure ramp up, especially with the auto makers, then yes, we could come out of those names to avoid some some choppiness.
John, I think this is insane. We are down 6%, Standard & Poor's 500 from the peak of late 2021. We are down 1.5% from the recent peak of days, weeks, months ago. I think it's literally August financial media hysteria going on. And I don't mean just TV and radio. I mean print and the whole, we got nothing better to do, so let's talk about SPX down 5 days in a row or whatever.
Yeah, I don't think anyone's suggesting this is a bear market, Tom. We're down like 15,
I think the tone is out
right
there.
Now.
A lot of, OMG, it's a bear market.
You think this is really negative?
It's a correction.
You think the coverage of the last week is that negative? I haven't found that.
No, I don't think at Bloomberg. I think we're just reporting the statistics. I mean, Critty Group is always very negative. But
you're blaming other media organizations.
No, I'm just saying there's a hysteria out there among our listeners and viewers over OMG, we're not going up 2% a week.
You are seeing some capitulation along that line.
How can you capitulate at a negative 1.44%?
Because people have been so positive, and I don't think anything has been priced into this
market off of October.
That's exactly right.
Let's compare multiples now compared to the start of the year. Just how much multiple growth has there been?
Well, the gains that we've seen in earnings are all PE expansions, right? It's not the earnings itself that are really driving it. And we're actually in the third month of an earnings recession going on here. So I think we have to be very cautious. It's one of the things you look at. Valuations are too high, especially for the level of inflation that we're at. So we're going to have to see something give, and I think it's probably going to be PEs.
Well, the question we've got to ask is, where does the earnings acceleration come from into next year? Where's that coming from? Who's driving that?
Yeah, I don't know. We're not seeing it, really and truly. Is it going to be more hope? Is that what's going to get us there? To me, that's pretty shaky ground if that's what you're betting on.
So what's your top kind of shift heading into the last couple of months of the year?
Well, we've always been cautious this year, and we've talked about that story, but adding some cyclicality to your portfolio along with some of your more value-focused names, I think is really smart to have that balanced approach. And so I think you need to do that. Have some cyclical names. Look at the finance names. Banks have taken a hit, obviously, just because of the headlines over the last few days, the downgrades coming out of Moody's and then Italy as well. But financial services should do quite well. A Visa, a MasterCard, maybe an Ameriprise, names we own just for full disclosure. But I think you can find pockets. The correlation between stocks is very low right now. That tells us it's a stock picker's market.
I don't care. What I want to know, the reason we had you up here, thank you so much for coming in. Can you explain Astros-Rangers rivalry? I think for people like us, it's like literally a foreign country. Is it a big deal, Astros-Rangers baseball?
It's a big deal, but I'd say it's not as big a deal now as it used to be. But look, Houston, Dallas, there's a rivalry on everything there. So even though we're in the same state, we are worlds apart.
John, road trip, Labor Day weekend, September 5th.
Yeah.
Astros-Rangers, and I think it's near Dallas.
Which is the team that cheats?
Up in Arlington.
Oh, listen to you. Whoa.
I know which the team.
I think it's time for me to go on that one now. It's the ones that won the World Series twice.
Right?
Yeah,
right. That's the team that cheats. Okay. Victoria, thank you. It's good to see you.
Thank you for
I knew that. Victoria Fernandez at Crossmark Global Investments.
You were going to have the second guest in 2 days walk off the set before the segment was over.
Yesterday, Binky agreed with me. I don't think Victoria was going to be quite as nice.
If you are just tuning in, welcome to the program. Here's a check of the equity market on the S&P 500. Equity futures look like this, positive by 0.2%. Coming up in about 48 minutes from now, Daryl Cronk of Wells Fargo to break down this market. Tom, do you think it's been that negative, that pessimistic? I would argue the opposite. I think we've started to see, to what Victoria said, some real capitulation from people who haven't been in this market.
I agree. We're seeing that, but people are addicted on a week-by-week and a month-by-month basis to up, and away, and it's happened coming out of the bull market. To me, the arch question that Victoria and Crossmark, Bob Dole, and all of them have to live every day is, where's the second leg of a bull market? That's a lot harder to find than coming off the gloom of the first leg.
The negativity might be that more people are coming here and saying consolidation. Even the bulls are saying you could see some sort of consolidation, and then you go in and you buy, which isn't exactly particularly negative. I think maybe you're hanging out too much with, some people who might be a little more negative.
I think corrections are a normative function, and in the modern day of finance, corrections feel like a bear market. A bear market's 18% and often 25 or 35% down, and we're worried about a pullback of 1.44%.
Yeah, I hear you.
No, I'm sorry. I think it's ridiculous.
Can you point to someone who is worried about it?
No, I think there's a lot of people out there addicted to the day after day up of the market. We didn't go up today. What happened?
Right.
We were wrong.
Is that the Dow Points crowd?
No, it's not the Dow Points crowd, because they're looking at a 3-year, 5-year hold. But SPX with a
I think
waiting,
people who quote Dow Points are the kind of people that get,
they do
all fired up about 5% moves.
How about people with 5.0 lift ratings?
Them too. He's more fired up about people being fired up who aren't fired up. Mark Cabana, about 20 minutes away on the rates market from B of A, from New York. Good morning.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America. We have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Every time you get indicted, I like to check the polls because one more indictment that I think this election's over. But these incredible numbers are the primary reason that crooked Joe Biden has weaponized law enforcement. They rigged the presidential election in 2020, and we're not going to allow them to rig the presidential election in 2024. We're not going to allow it to happen.
The former President Donald Trump speaking in New Hampshire, not exactly backing away from the allegations he's made over the last several years. Tom, those accusations continue, and those criticisms, those insults laid at the president's feet, also laid at the feet of Chris Christie, the former governor of New Jersey. The former governor of New Jersey, Chris Christie, snapping back on Twitter, X. If you had the guts, you'd show up to the debate and say it to my face. We're going to see if the former president even shows up to those debates in a couple of weeks' time.
I do agree. In the last 24 hours, it's gotten a little more testy. There's been some other things I've seen. I can't remember the names, et cetera, out in the social media. But do you agree, John? The pushback meter here has gone up a little bit in the last 24 hours?
Just a bit. That's pretty fiery stuff.
Yeah. I mean, Chris Christie was on fire yesterday. And, of course, the former president speaking as well. I guess I'll address that right now with Wendy Benjaminson in Washington, hugely briefed in our political moment in America. Just, Wendy, very quickly here, when do we see an indictment in Georgia? Is that on the Benjaminson calendar for August?
Yes, it is. It's most likely next week. There were some final subpoenas, we think final subpoenas that were issued early this week, and the grand jury meets, we believe, on Monday and Tuesday. And maybe on Friday. Anyway, we do expect them to come out next week. And the really interesting thing about this indictment is that this is the one in which Trump could not pardon himself if he became president, because they are state charges, not federal charges. But other than that, it is the fourth indictment. And, you know, that clip you showed, he's not wrong.
Wendy, I think beneath the radar in August, and it's not beneath the radar, it made legitimate national headlines, was, again, to go to states, state legislatures, state judicial systems. It doesn't make for fun and games in Washington, but boy, it's important. And yesterday, Ohio was important. Explain to our audience the immediacy of when a state decides on key national issues.
Well, you framed it exactly right, Tom. I mean, Ohio was hugely important yesterday. What we saw was a rib-rocked red state. This state has been going for Donald Trump and for Republicans for a very long time. And then abortion rights advocates were going to put a measure on the ballot this coming November. And Republicans put a measure on the ballot yesterday for an August election, saying that any ballot measure to change the state constitution must now have 60% support instead of just a simple majority. And voters turned out in Ohio to stop that in numbers higher than in the 22 election, when the governor and the Senate and House members were on the ballot. This time they turned out in massive numbers and defeated it by 57%. So all that means at this point is that the abortion measure will be on the ballot in November. But it wasn't, anti-abortion people who were showing up for that. So it shows that there are these chinks in even a, fully Republican state when it comes to certain issues. And that could be one thing that, could hurt Donald Trump later.
Wendy, I want to go back to this point where we are hearing a definite tone shift among the Republican candidates to be the candidate for president, basically increasing pushback against the former President Trump. We heard that from Ron DeSantis saying clearly Biden is the president and won the election. We hear that every day from Chris Christie. Why the substantial shift? Why suddenly are people saying we don't care if we lose voters, or, you know what, we have to go this route even if we do?
I think it's the latter, Lisa. I think it is that they are saying they are not moving in the polls by being supportive of Donald Trump. They must distinguish themselves, and they have this debate coming up on the 23rd, which Trump may or may not show up to. And if he doesn't, they get 2 hours to make their case to the American people and distinguish themselves in some way. And so far, supporting Donald Trump has not done it. I mean, Chris Christie, as you pointed out, is the most ferocious against him, is the toughest attacker. I'm not sure how that's resonating with Republican voters, although he is inching up a bit, and it would certainly help him in the general if he were to win.
Last night, the New York Times put out a report about this secret memo that has been revealed in one of the recent allegations against the former president about January 6th that actually lays out a strategy of how to basically win an election, regardless of whether there are the votes behind it. Does this change the game materially?
Well, I don't know that it will change the minds of the people who already believe Donald Trump when he says he is being persecuted for political reasons, although it really is rich in detail laying out the strategy and what Jack Smith, the special counsel, calls a conspiracy in legal terms to overturn the election. There was a memo laying out, let's get the fake electors going, let's have them vote for Trump instead of Biden. And yeah, the Supreme Court will probably overturn it, but by then it may not matter, which is really sort of surprising to hear, lawyers for the President of the United States saying this. And they lay out the plan to request Mike Pence to overturn the election once he gets to Congress on January 6th, which of course we know he rejected out of hand. But it is a very detailed, very rich memo that pretty much lays out the plan that Trump accepted, apparently, because it all happened, right, except for Pence overturning the election, and certainly strengthens Jack Smith's case against him for conspiracy.
Hey, Wendy, on the latest down in Washington, thank you. Wendy Benjaminson there. Pushing ahead to the rest of the week, tons of economic data, Thursday, Friday. This note just dropped from Torsten Slog, Tom. I know you've read it as well. High-yield spreads disconnected from fundamentals. A lot of people have made that point. High-yield spreads at the moment are about 390, 3.9. So 390, Tom, over, which historically is still pretty tight.
After you lose money the third time because you're an equity idiot and you don't pay attention to the bond market, you start really paying attention to the world of Bramo. And this is a conundrum, as Mr. Greenspan would say. Right now, bonds are priced to perfection, price up, yield down, and that brings that spread where it is, Lisa, doesn't it?
Well, that's true. It also points to a very different market today than 20 years ago.
Fair.
The high-yield market right now is a very mature market relative to what it used to be. And you have the smaller companies that are more leveraged, going to private equity firms, going to private credit firms.
What is oil doing, which used to always be the challenge in high yield? Oil would get in the way and make the math not as good. Are they going to private equity?
Well, the oil companies were a big concern in 2014. You saw that as a significant proportion of the high yield index. Since then, because of what happened in 2014, you did see a real decline in the proportion of oil companies that are represented in the high yield market. But overall, they've got better credit, they've pushed out the maturities, and so people are looking at that and seeing fewer defaults relative to the cycle they're expecting.
That maturity wall out somewhere in 2025?
Exactly.
We'll start thinking about that in 2024. Oksana Aronoff of JP Morgan made this point, who's incredibly bearish, I have to say, based on what I heard from her in the last week or so. And Tom, she thinks that if we're not reducing rates by next year, and then we start to factor in these companies coming back to the market and what they'd have to issue debt at, compared to what the debt profile looks like now and their borrowing costs. Tom, it's going to hurt. It's going to hurt.
And I have great respect for people like her and everybody we talk to daily here, folks. I mean, these strategists have a responsibility to look out 6 months, 12 months. To us, it's blah, blah, blah. But it's a really tough thing right now. There's just too many moving parts for me to look out to March of next year. There's just too many things going on post-pandemic.
This, to me, highlights the distinction between raising rates to a certain point and keeping them there. You keep them there for long enough, and suddenly these companies are going to feel real pain that most people are looking past right now.
Especially as inflation is coming down.
Correct.
And to Williams's point earlier this week, real rates increase. Market banner of Bank of America coming up shortly. Your equity market on the S&P 500. A little bit of a lift, but that lift fades. From New York, this is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Equities positive here on the S&P 500, on the Nasdaq too. On the S&P positive by 0.1%, on the Nasdaq up by a similar amount.